I would love to welcome everybody to our open session. It's 8:30. Can we have roll call, please?
Teresa Taylor.
Here.
Rob Fechner.
Good morning.
Frank Ruffino for Fiona Ma.
Present.
Lisa Middleton.
Present.
David Miller.
Here.
Irene Ortega.
Here.
Jose Luis Pacheco.
Present.
Ramon Rubalcava.
Excused.
Melissa Willett.
Here.
Dr. Gail Willis. I think she's still connecting on.
She's still
online.
connecting?
Yeah.
Okay.
And then Betty Yee.
I haven't heard, so I can't say either way. All right, we have a quorum. So right now we will recess into closed session for item 1 from the closed session agenda, and we will immediately reconvene into open session after the closed session. So if everyone would leave the room, I appreciate it. in open session. And I believe I am going to adjourn this meeting, and we will have investments at, I think we said 9 o'clock, didn't we? Yeah. Let me check. I thought we said 8:45. Oh, no, as soon as we can change over, then investments, David. It is all you.
I'd like to call the investment committee to order. There we go. And the first order of business is our call to order and roll call, please. Oh.
David Miller,
Here.
Rob Fechner,
Good morning.
Frank Rufino for Fiona Ma, Lisa Middleton, Irene Ortega, Jose Luis Pacheco, Ramon Rubalcava,
Excused.
Teresa Taylor,
Here?
Melissa Willett, Gail Willis, and Betty Yee.
Not sure yet. Okay. Thank you. We'll move on to the executive report from our Chief Investment Officer. Okay, Dan. you can- Oh,
Christina?
oh. Well, no,
Call your roll.
Betty Yee,
okay, all present and accounted for. So we'll go forward. Dan?
Yeah, Mr. Chair, Nicole, I think, is just hung up for a minute.
Oh,
If we can wait until she gets here to kick us off.
No problem.
Thank you, Mr. Chair.
Good to see everybody here and some familiar faces. Everybody's enjoying this nice, cool weather.
There she is.
Oh, I thought it was at the end.
You're that one. This one's me.
Good morning,
Okay,
everyone.
you have the floor.
I got the floor now? All right, good stuff. Good morning. Thank you all very much. I was looking forward to being here. I know my last go around I had COVID, so I'm super happy to be here and healthy and in person. So thank you. I know we have a really thick agenda today, which the team's been preparing for some time, and we're looking forward to really just having an open dialogue today, really hoping to take a look back at history, take a look at where we've been, what we've done, maybe some decisions we've made that we would like to reflect upon, certainly try to give some perspective on where we're going. And so you'll see today with the agenda, we've added an additional piece, which is the performance review over the last 10 years. So we'll take some time to walk through that. Part of that look back, we will come to you with some suggestions, some requests, and a first read of some policy changes. We're then going to do the typical program review that historically we would have done all in one package. That's part of 5C. And really, again, the intent here is to make sure that we all walk away giving you the understanding that we're here to be held accountable for performance. We're here to make sure that we are all in this working towards the same goal of paying pensions and benefits. And we're going to have a real humble dialogue today with you. So we're looking forward to doing that. So I think first up, do I go right into the performance review at this point, or do we have to go through? I turn back to the chair. Okay, turn it back. Thank you.
Thank you. Yeah, we'll have a very full agenda today, and so we'll start with action consent items. And we vote on these, we'll vote on them together, I guess. Is any? Okay, moved and seconded. Any discussion on the motion? Okay, all in favor of approving the action consent items, say aye. Aye. Oh, roll call vote? Okay. Oh, okay. Yeah.
Rob Beckner.
Aye.
Frank Rufino for Fiona Law. Aye. Lisa Middleton. Aye. Irene Ortega. I'm sorry. Jose Luis Pacheco. Aye. Ramona Bocavo.
Excused.
Teresa Taylor.
Aye.
Melissa Willett. Aye. Dr. Gail Willis. And Betty Hughes.
Okay, the ayes have it. The motion passes. So we'll move on to item number 4, which can we advance the, there we go, information consent items. I have no request to pull anything, so we will move on to item 5. Oh,
Right at the top, there you go.
okay, Melissa. Okay, there you go.
Is this the right? Okay. Oh, thank you so much. So on the draft agenda for the November investment committee meeting, I know we have the responsible contractor program is listed as a information consent item. And I think it's a signature part of the CalPERS program that's establishing our ESG principles and values. And so I think I would like to see this as a full information item. It's been historically, and I'd appreciate a full report, as this information is really important to our work.
Yes, thank you, Ms. Willett. We are moving that from an information consent to an information item for November.
Thank you.
So I guess consider that a proactive move by staff. Otherwise, it would be committee direction. Okay. No further discussion on that. These are information consent items, so we can move on to our information agenda items. And with that, we'll start with the investment performance. And so I'll turn it back over to Nicole and Dan.
Great, thanks very much. Unfortunately, I'm having some technical difficulty with my access to diligence, so I'll have to be looking up and down at you if you don't mind. I've got my talking points in front of me, though. Technology never fails. So thanks again. As we mentioned, I know typically that we do the performance presentation within the semi-annual trust level review, but we felt, just given where we're in such a unique year in relation to the markets and our performance, so we wanted to have this opportunity to do a proper deep dive. And really looking at over the past 10 years, we'll still, sorry, thank you. We'll still certainly have an opportunity to dig further into our performance once we get into the trust level review, but this is a unique item for us. So if we turn to slide 2, the agenda, please. We'll look at we're going to take a look at, we're working through a new PERF performance and risk snapshot. We're really trying to develop tools, and along the way today we'll be introducing you to some of those tools that we've been using as a team, and we'll walk through them, and hopefully over time it'll become tools that we're sharing together. We're going to review our 10-year performance. What we tried to do here is really use a group of peers, if you will, as a benchmark, and really dig into what have we done versus them, what does that look like over the last 10 years, and where are some of the opportunities. Really focus, frankly, on where we've fallen short, and we're going to get into that today and talk about it, and then discuss where we can go forward based on all of those lessons learned. And then we'll leave some time at the end for questions. Next slide, please. So this is what's beginning. We're really starting to work through a snapshot. This is our 1, 3, 5, and 10-year snapshot, trying to really try to standardize how we take a look at performance and risk, make sure we have a great view into asset allocation. This asset allocation as of June 30th, so it would reflect the prior asset allocation, but it just gives you a sense going forward on how we will be keeping a close eye on many of these metrics. As you know, our ending market value was down almost $30 billion for June versus June 30th, 21, and closer to down $60 billion towards the end of the year. And so that's, a big piece of why we're so focused today on making sure we really dig into what we've been up to in the last decade or so. I think it's important for us to reflect on our absolute returns this year. Obviously down being a negative 6.1%, which is the first negative fiscal year return since 2009. Cumulatively, the longer-term PERF performance of 7.7% over the 10-year period, while we marginally exceeded the actuarial rate of return, we are examining our decisions on what we could have done better in over that period of time, and that's really the focus of today's discussion. From a 5-year, I'll just bring your eyes to the realized 5-year information ratio. We're not going to get too much into some of the more, the nuances of Sharpe ratio or information ratio today, but as a CIO, I would tell you when I look at that number, it's frustrating or disappointing. It tells me that we're just not getting the return on risk that we should be getting, and so part of my conversation today with all of you is what we're going to be doing differently and how we're going to be spending our time and resources to make sure we can improve upon that. We can go to the next slide, please. So today we'll probably go through, I counted it's about 12 points, 12 areas of focus. Maybe it's the top 10, maybe it's the top 12, but really it's the bullet points, and we'll leave time at the end. But the first area we should look at is these cone charts are really helping us in a graph really see clearly that our returns have been just frankly lower than expectation. You see the blue line, really you want to see that line between the orange and the upper part of that cone, and it just hasn't been. We would have expected from the period of July 1st, 14 to the end of 18 to have an annualized return of 7.6, which you see there in the expected column, whereas we realized 5.6, so a difference of 2%. Really the portfolio priorities during that time, from what I could see, what I've been told, was really more of a product of trying to create a portfolio with less drawdown risk. But with that decision, it means that we really missed out on that 10-year era of growth. And so it's something for us to be reflecting on. From the period of July 1st, 18 to most recent fiscal year end of June 30th, 2020, we had an expected annual return of 7%, and we produced a return of 6.2%. Again, similar observations. We were constructing a portfolio to limit downside, and with that, we missed out on a big chunk of growth. Next slide, please. So here we try to summarize, really get into the heart of where our performance has differed. Again, this analysis, this peer group, if you will, is a compilation of larger plans, over 10 billion. It's kind of a hypothetical portfolio that we pulled together. But the messaging with this hypothetical portfolio is pretty consistent as far as where we steered wrong or what we could have potentially done different. Really, the punchline is you'll see the vast majority of our underperformance. So if you look at the far right of 10-year, us coming in at the 7.6 versus a peer group of 8.9, big driving factor of that would have been around our private markets program or lack thereof. And we'll get into the weeds on that going forward. And really, I think if you think about where our allocations have been and the importance of allocating to growth, it really comes out loud and clear here between the public equity program and the private equity program, where vast majority of growth assets would reside. That's where we are really underallocated. Next slide, please. So in addition to having lower overall growth exposure, if we take a sharper look at our private equity program, really this era between 2009 and 2018 was a period of time when we really stopped committing. Our pacing, our commitment to the program overall, it was really put on hold. And you'll see that clearly through this chart here, where you've got a very inconsistent deployment of capital during that period of time. And again, these are estimates, but it's just really to drive the message home. The impact of us not deploying capital during that period of time is estimated anywhere from $11 to $18 billion, and that's just because of inconsistent capital deployment. Next page, please. The next area we take a look at is our real estate program, and where have we been and where are we going as far as that. If you think about how our program is broken down in real estate, we have core program, we have opportunistic program, and a value add program. The core programs are typically investments that are characterized by low leverage with stable and predictable income. For value add, those are really investments where where returns are expected to come from the execution of renovations, for example, renovation projects. And opportunistic is really the riskiest area that we can invest within the real estate spectrum, and it also offers a chance for the highest return. So our observations here is really, given the allocation to the higher risk investments that we had, we really did expect to be compensated more than we were, and so that certainly hurt us. for our core outperformance was certainly due to the strong performance of our multifamily and our industrial and data center programs, and we were also underweight to office. But overall, we were definitely hurt by the fact that we were not paid for the risk we are taking in our opportunistic program. In recent years, the good news is that our program has transitioned back to core, and it's currently more than 90% of our real estate program. And there's been a lack of recent commitments to the value-add and opportunistic programs, which has also led to underperformance in those strategies as the returns are dominated by legacy investments in emerging markets. And so we've had a lot of work to be done in our opportunistic program, taking a look at some of the underperforming commingled fund programs, for example. So we're taking a look at that, taking a look at the programs or the partnerships that we would have had in emerging markets. And so these are certainly areas where, we've had to step back and say, how can we reposition the program, which is what's been done in the recent years. The program's been more repositioned to core. And so we'll continue to take a stronger look at what's going on there. Next slide, please. The next area that we've got some lessons learned on is our decision to go global for diversification and growth, really dating back to 2008. So rather than having a home country bias like many of our peers would have had, we did not have that bias. We did not go back to that until very recently. And so therefore, that decision frankly didn't work out as we had hoped. We really should have had more of a home country bias in hindsight. In hindsight, of course, we say is 2020, but that's really been where we've had a detraction from returns because of that lack of home country bias versus our peers. So again, just one of the many building blocks. And that was one of the messages I wanted to hopefully tease out today, is there was no one magic negative bullet. It's really a combination of a number of just different decisions, different market dynamics. So hopefully through the series of 10 to 12 bits that I'm uncovering or discussing today, the message should really be it's a combination of a number of things. The punchline being it's been mostly in the private markets area, but certainly not having a home country bias is another example of where we need to reflect upon that going forward. Slide 9, or next slide, please. So again, in a similar vein, it's certainly not the reason, it's one of many reasons, but we have the factor-weighted segment, which was added to the strategic asset allocation in 2018, meant reducing beta exposure within public equities, but it also meant and means that we do miss out on the upside while we're dampening the volatility on the downside. And so in these recent years, again, this segment would have detracted from the total returns, but it did reduce the impact of downturns, of drawdowns in the first 6 months of calendar 2022. So it was working, but this exercise was to take a look at, why our overall returns are lower than our peers. And so while this segment of the strategy was so-called working for what it was intended to do, it did detract from returns during the recent times of growth. Next slide, please. In that theme of detraction, we've got our long duration of our fixed income program, certainly also detracted more recently. Long duration, however, has certainly helped us over the long haul. It's really just been clearly in the 2018 to 20 time range when rates declined during COVID, that we've really been impacted by that longer duration approach that we've been using. So it's certainly an area that we are looking into now, given where we are with rates and inflation. Next page, please. So deployment into active strategies. This is one that's really interesting. In the chart, sometimes these charts really jump out at you. clearly for an extended period of time, we had a number of active programs that just were not working out. So the decision was made in 2019 to take a really deep dive review of those programs, and it was decided to reduce active risk within the programs. And so you can see that clearly. So as a result, we really did move capital back to more of a benchmark exposure. And so back to one of those earlier slides, you'll see over the course of a few years now, we've really not been using our active risk budget. That's a topic that I really want to get into more deeply in our next board meeting. I'd like to take some time to really talk about my strategy or my hopes for what we're going to do with active risk in general, how we change our active risk culture, how we think about what programs we should be layering in. But the message again today in this 10-year look back is that this is certainly one of the pieces to the puzzle, is the fact that we've pulled out of some of these active strategies, most of which we're not performing, but in general, we've just not been using our active risk budget to the extent that we could be. Next slide, please. This is just to give you, more just a better understanding or the justification why at the time we would have pulled out of active management. Our programs were just not consistently adding value. Again, similar to those earlier cone charts, you'd like to see that blue line above the orange hypothetical excess return line. That would have been our expected return on those active programs. And as you can see, we've been experiencing much less than that. And so putting a real focus on those active programs is certainly an area for value creation potential that we'll be spending a bunch of time on going forward. Next slide, please. So part of our, the top 10 to 12 reasons, I just wanted to highlight just this whole idea of consistency in strategy, just remembering that we're long-term patient investors. It doesn't serve us to be coming in and out of programs. We have the luxury as long-term patient pool of capital that has ample liquidity to be patient and not to be taking, drastic decisions to completely pull out of asset classes, for example. And again, I just say that with the benefit of having a lens and looking historically. But as I mentioned in the outset, pulling out of the private market program is probably what's hurt us the most. And this chart was just simply to demonstrate we've had a number of start and stops. And so we really need to be thoughtful. A lot of this really, in my mind, boils down to taking us a much closer look at the decision making and our model for decision making, our governance model for decision making. And so you would have heard me say in those first couple meetings we had together that after my walking tour was completed, I really focused mostly on our governance structure. And I'll get into the weeds a little bit on how we hope that we've improved upon or we can avoid having these start and stop decisions without making sure we're thoroughly vetting the unintended consequences as well as consequences of doing so. And so this chart is just simply, again, to demonstrate one of the pieces to this puzzle is that we had frequent changes in strategies, and that certainly detracted from our return profile. Next slide, please. So in summary, these are the areas that we are going to be super focused on going forward. We'll touch on a number of these areas when we go through each of the program reviews. I'll spend a bunch of time with you talking through what I'm going to do about or do differently in each of these areas. But again, to summarize what's gone on over the last 10 years, we see that our returns have been lower than expected. We've underperformed peers. We've had inconsistent pacing with our private market programs. In real estate, we had some missteps within our value-add and opportunistic programs, but we've now repositioned that program to core, and we'll explore further what we can do about the higher expected returning buckets of value-add and opportunistic. Our non-U.S. home-biased approach historically did not serve us well. The factor-weighted segment certainly detracted from value, but I don't want it to be lost that it did do what we hoped it would do, i.e. dampen the downside during this most recent volatility. But as far as detracting from overall returns, that is a fact, it did. Long duration fixed income in these very recent years, again, detracted, but has served us well over history. So it's not something we would suggest just completely changing on, but we will use every tool in our toolkit, certainly, and be exploring those. And, deployment of capital into active strategies did not consistently add value. So that's more of a question of not only what programs are we doing, but how do we make decisions around our active risk programs? How and when do we decide? How do we decide where to allocate our risk budget? How do we decide what we're going to expect out of those active programs, et cetera? And so we'll be spending a bunch of time together in the coming weeks and months walking through that. I'll be walking through with you my ideas on each of these elements for sure. Next page, please. So lessons learned, I walked you through the 10 lessons that were certainly pointed out through this 10-year exercise. What's our path forward? We certainly learned that we don't have the luxury of just setting an SAA and setting and press go. We certainly need to be reevaluating more dynamically, more frequently. We really need to make sure that we have a culture that allows for and supports and holds folks accountable for active risk taking. We really need to develop and prioritize a framework for innovation and to make sure we're constantly revisiting, are we resilient? Have we set ourselves up appropriately given what's going on in the market, as opposed to, as we said earlier, kind of set the SAA and go. And to do so, we really need to be developing a robust governance framework to make sure that our decision-making is benefiting from timely, agile decision-making, but also making sure that we have the tools in place to act when the market suggests that we should be acting, as opposed to just waiting it out. Next slide, please. And so for me, my goal really is to build a culture where we are held accountable and are making sure that we're very focused on building this innovation and resiliency into the program every day, making sure we have the right people in place, making sure we have the right technology in place, making sure that we're monitoring in a consistent way our performance, and making sure questions are being asked in a timely way, that we're agile so that we can react to opportunities in the market, so that we're deemed to be agile to our investment partners. And so between the risk management capabilities, which I'll touch on again more so in our November meetings, but we're certainly working on from our focus on our sustainable investing. We're in the market right now for some very key positions in that area. Tech and innovation is one of our 9 core business objectives this year. We think that's super important. Talent and culture is the thread that runs through all of this. Our assets go up and down elevators or stairs every day, and so it's a huge area of focus for us. And that really boils down to us having more of a total fund management approach. Historically, we've taken, as you've seen in the 10 to 12 areas that we focused on today, at times we've been quite siloed, and that's on us. That's on us to make sure that we're not siloed. It's on us to make sure that we really think through a total fund lens, and what that means is decision-making, risk allocation, risk budgeting, all being done through more of a total fund lens as opposed to, one-off or a more siloed approach. I think the good news that we should remember, if you want to skip to the next page, please. I think the bright light here is that the strategic asset allocation process that you all underwent and approved last November and we set in place for July, I feel really does set us up for success. I think we've got the right tools to work with. I think that we're now, because we've done this deep dive, we've acknowledged that there's different ways for us to be executing on that. It's the strategic asset allocation. There are more tools available to us, and probably more importantly, we have to make sure this culture of innovation and resiliency is really woven through our governance framework. And so our hope, our desire is that we make it abundantly clear that we know we need to be held accountable for our performance going forward. We've humbly taken a look at steps that have been made in the past, and we have learned from them, and we will learn, and going forward we'll execute on those lessons learned. So maybe with that, I can pause and take questions. It was a high-level review, and as I said, we have a lot more time during the actual program reviews, but we thought it was important to separate and have a separate agenda item today just to highlight kind of those top 10 to 12 areas where we have underperformed our peers over the last decade.
Yeah, thank you. That's very helpful, and I think it's a very encouraging and forthright presentation, and I have a number of board members who would like to speak and discuss this further. So I'll start with Teresa Taylor. Yeah.
Thank you, Chair Miller. Thank you, Nicole, for the presentation. I do appreciate the look back. There's a couple of things I remember asking about and being kind of brushed off. One was how come we are overweight in international and public equities, and was told that there was a reason why, and this was some years ago. And we apparently stayed that way, even though we returned poorly throughout the years after I asked that question. I am a little disappointed in our, and I get it. I know there's lots of things that go into the bucket of why our performance has been poor, and especially when you look at it towards our peers. I'm just hoping and that looking forward that you're, and as we go into closed session, I know I can't ask for specifics right now, and of course I will be later, but one of the things you mentioned, let me just go into one of the things that I wanted to know about. No, first one was the value add and opportunistic real estate. So that didn't pay us. So can you explain that a little bit better? Because we did take some risks there, and it didn't. We got
we're gonna gather. I'll certainly answer to the things that I'm familiar with, but I've got a team here that's got a couple dozen years of experience here.
Absolutely,
So
I appreciate
I'd love for you guys to get as direct and transparent of an answer as possible. I'd like to call up Sarah just as we're discussing real estate.
Sarah Corey, Investment Office. The underperformance in value add and opportunistic actually goes back probably pre-GFC, when the portfolio was 40% core and 60% value add and opportunistic, and we did a bunch of development that didn't work out. Since that time, we've moved it from about 40% core to almost 90% core. So we really haven't done much in the value add and opportunistic space, which means what we have there is very old and not performing. Now that we have 90% exposure to core, we'll probably add some more value add and opportunistic back in, and that should perform better than the legacy assets.
Okay, and those legacy assets were prior to the Great Recession, is what you're saying? Correct. Oh, okay. Okay. Yeah, we probably should do that. I appreciate that. My next question, and I appreciate that, Sarah. I don't. Wait a minute. Hold on. Yeah. So my next question is on not factor weighted, but the active management in public markets. We didn't do too good in that. Should we do more? Should we do less? What are we looking at? In a general fashion, I don't want us to.
I'd say, Teresa, in a general fashion, what my hope is that we are going to get a lot more focused on making sure we're being held accountable for making a return on any active risk we take, period. From my perspective, looking back, I think that we could have done a better job at looking through our active risk programs more holistically, more through a total fund lens. I think that we should have been a lot more prudent on measuring the risk we are taking and whether we are getting paid for that risk. I think that we should have been more thoughtful about where that active risk was being deployed. I mean, deciding to take active risk is as much about the market opportunity itself, but also on our in-house capability of assessing where that active risk should be taken. And so a big chunk of the time we'll be spending in this next chapter of my first year is going to be exactly on that, is really making sure that we have the right tools in place, the right culture in place for risk taking, the right measurement, really thinking about our active risk program more holistically. And that is it's a cultural shift, frankly. We have to make sure we create an environment where people don't fear taking risk, because if you're punished every time you take active risk because folks assume that when you take active risk it always pays, then people are not going to be motivated or incentivized. And similarly, if we just take active risk without measuring and being held accountable for getting the appropriate level of return on that risk, we're not going to like the outcomes. And so there's a chunk of work to be done there, Teresa, to be frank. And I think that we will really benefit from having that practical shift, the cultural shift, and just tied into systems and people and culture. All that intangible stuff that we often talk about is a real thing when you're trying to create a culture of active risk taking that gets paid for the risk that we're taking. And so that's going to be my focus.
That's excellent. I appreciate that. Along with that, I was curious about the public equity factor-weighted segment where it marginally detracted. So that sort of paid us in the downturn, right, which was what we were supposed to be doing. So this is where I get a little frustrated. So when we had a good return year, we were still under our peers, right? And that was told to us that that was going to be because we're, using risk, we're risk averse. We're going to, make sure that we have the, in a down year, we have better returns because we're doing that risk mitigation, right? So that's not what happened, though, it seems like. I mean, a little bit of it happened. So I guess what I want to know is how do we make that work better, right? Our risk mitigation factors, along with all of this other stuff. I mean, you just talked about the active management, right, and active risk taking. How do we do the downside risk as well and still get paid, right?
Yeah, and I think we have to take, again, a more holistic review of the portfolio just for growth in general. Where are we getting our growth from? Separate and different from where are we helping to dampen downside, or where are we getting our downside protection? It's it's easy to narrow in on any one of those 10 things that we flagged today and say it was the be-all and end-all and it was our demise. But at the end of the day, the bigger story here is through across the asset class opportunity to capture growth, we were light, or we didn't have the appropriate, leaning into active risk in the right areas that were returning the appropriate risk-adjusted returns. And so I would suggest to you that you need to have those types of programs that are focused on the downside. We need to be more holistic in our thinking on where we're getting growth from and making sure we're getting paid for the risks that we're taking in those areas. And so there isn't one magic answer. I'd say that we can't look at any of these one programs in isolation and say that's where we really, that's where we miss the opportunity. Other than really seeing, and we saw it in a number of the charts, the biggest impact by far was the 10-year we took a break from participating in private equity. And that, no matter what we would have done on the other things, and we've done the math and we've run this narrow but big picture messages, no matter what we would have done with duration, with factor weighted versus cap weighted, opportunistic value add, none of that matches what we missed out on by not being in the private market program. And we are certainly fixing that now.
And I agree, and I appreciate that. And I just want you to know that the board, whatever it takes, right? We want to be able to pay benefits far into the future. So whatever it takes so that we can move the portfolio in the right direction. I think the board would be on board with that. Let's just listen to each other. Thank you.
Thank you.
Okay, next I have Controller Yee. Come on, let's try it again. There it goes. You're on.
Great. Thank you, Chairman Miller, and thank you, Nicole, for the report. I very much appreciate the straightforwardness, but also the challenges and the path forward that we'll be focused on. I'm hopeful that the board will be getting more frequent reports of this type, just given the environment in which we're all operating. And I know at the staff level and with your team, that will be ongoing work. But I think part of governance is also just, kind of engaging the board more on these issues as well. Just on the issue of risk, I have a ton of questions on this, actually. You raised the issue about not being adequately compensated for the risks that we took on, but just in terms of the comparison with peers, did we take on more or less compared to the peers?
It's an interesting question. It depends on the asset class. So I think, those are, it's a complicated question, and I think perhaps maybe that's our next deep dive we do, is to give the board a better understanding of where we are from our own risk appetite, our own risk profile versus different groups, because it's such an important ingredient into how we compare to. Because again, we created this presentation because the question is, why have you underperformed? And so we wanted to dig into the performance or the returns or the headlines of each of those asset classes. But exactly to your point, Betty, there's so much more to it. Are we taking, what is our risk profile versus others? Are we getting paid for that risk? And I think that's the next step of our journey, to be frank, is it's more than just beat our benchmark, because we all know that that's not going to pay the benefits. We need to really take a much deeper look at the risk that we're taking or not, and whether we're getting paid for that risk. And so it's part of our journey.
No, and I appreciate that. And I think one of the main considerations for this board is how much risk are we really open to taking.
Correct.
So would really welcome that deep dive. And then with respect to our risk mitigation strategy, which was developed really centered around our investment return, rate of return, compared to peers. I mean, just in terms of constructing kind of a risk mitigation strategy, some, and I'll just talk about the other fund which I participate, where it's actually an asset class. When you look at coming back in November with that discussion, will it, the capability question, will that be part of it? It's just how it's constructed as well?
Yeah, absolutely. I think, we have this dialogue on our team all the time now. Are we using all the tools we can? Yeah. We're also being very frank that the last 10 years isn't going to look anything like the next 10 years. And so things that worked in the past, we really need to be thoughtful and make sure we're not, as we said earlier in the presentation, we're not in a set-go mentality, that we're really taking a look and poking at each other and using the benefit of everyone around the table, which again, when we get into the next presentation, I try to go into a lot more detail as to why we've set up these governance committees, why we think they're beneficial, precisely for these types of conversations. Mm-hmm. There have been fits and starts historically at CalPERS into some of these risk mitigating strategies. And again, I go back to the comment I made earlier around having the appetite, having the culture that doing those types of activities, sometimes they go well, sometimes they do not. How do folks feel when they take the risk to add on some of these programs? Right. A lot of that, a lot of it is just this human nature bit of investing and risk management. And so our next chapter of our journey is really digging into all of this. Why did we make decisions we made, and what stands in our way from making different decisions going forward? And do we have those tools in place? And having that dialogue with the board to make sure that we all are very clear with one another on the risk appetite of the board, and are we doing our job at executing on that? And are we sharing with you the pros and cons, or the pitfalls, or the gaps, or the missed opportunities we may all collectively decide is the right answer because of the risk appetite, for example? I feel like that's a whole big, important journey that we need to go on together.
I agree. Yeah, and I welcome that. I especially appreciate your emphasis and focus on governance. I think the people, the processes, the technology, all of that is going to contribute to how we build this culture is really important. I think my question there is not to complicate things, but as you're looking at developing this culture, there are going to be externalities that continue to kind of put pressure on us, and I'm not sure this is a bad thing, but how would you overlay, I guess, the work that we need to continue to do relative to achieving a net zero portfolio by 2050? So, here we're trying to kind of just really do a deep dive in terms of just other capabilities that can be brought to bear. We are looking to not keep doing these starts and stops with respect to our strategies, but we also kind of have this larger kind of global focus that other investors and peers are focused on. But can you just kind of comment about kind of how that gets overlaid on top of the work that we're going to need to do that you've just described?
Sure. I think maybe I'll start by trying to give you some comfort. I mean, one of the early conversations that Marcy and I had when I first joined was, how do we make sustainable investing just in our veins, just part of our everyday way of doing business? And one of the first of many things that Marcy gave me support on was to bring the sustainable investing function, if you will, over into investments, to report into CIO for now, perhaps the DCIO of private markets, but really the outset, because I think it's one of my top priorities, is to make sure that we don't think of sustainable investing as a side hustle or as something off to the side of our desk, that we figure out how it's just completely integrated into everything that we do, strategy-wise, go-to-market-wise, our branding, everything. And again, that is a bit of a journey though, right, Betty? That's not something I can flip the switch on, but I can start with tone from the top. And Marcy and I are very, locked arm in arm on that approach here. And so I guess it's a long-winded way of saying it's top of mind for us just to make sure that we are sustainable investors. It's not a separate strategy. Right. It is absolutely a part of the conversation and the decision making. The governance that we have, being a sustainable investor is just like, what's the risk adjusted return we're expecting? It just becomes part of the dialogue every day, as opposed to, let's go do some neat projects that make us feel good.
Good. I really appreciate that approach, and I think it will be one that will serve us well in the long term.
And it'll take time, and we'll have to bring the board along. I'm going to have to show you. Sometimes it'll feel like we're making baby steps, and other times it'll feel like we're making great strides, but we just want to keep the momentum going. And, we aren't starting from a standing start. We've got a lot of great things already in the works, but I think just really pulling this all together, and again, making sure it's not something that's off the side of our desk, but it's integrated into our decision making.
Absolutely.
Is super important.
Great. Thank you. Really appreciate the report. Again, thank you, Nicole. Thank you, Mr. Chairman.
Okay, thank you, Madam Controller. And next we have Frank Ruffino for Fianoma.
Thank you, Mr. Chair, and thank you for the presentation. Just two quick questions, one clarification. But the first question is back to the page 5 slide. It was, I think, the third or the fourth slide. The returns lower than peers. So that shows the CalPERS trailed peers about 1.3% per year over the past decade. So were CalPERS returns more or less volatile than those of the peers?
I think it depends on the program again, Frank. I think you have to really break it down, and we're more than happy to come back with that and continue to get in the weeds on each of these differences. This was a very high level, more of a directionally, here are the 10 things that we really need to do our homework around as to why and how we could have done things differently, but it would really depend on the actual asset class or the program to answer that question. I'd say in general, you'd see from the CEM benchmarking, we've taken less risk overall and got paid less for the risk we took. And so that's not a combination. That's not the quadrant we want to be in. And so we need to work on that.
Okay, great. And I know you already made a comment about active management in the public market, and I'm not sure if I was clear, if I understood you clear. So given the noted challenges of active management in the public market, should CalPERS consider reducing active management exposure further, giving its higher cost?
Yeah, when I talk about active management, I really think of our program in two ways. We've got a massive beta part that needs to work with the policy, and it's our beta exposure, it's our index stuff. And then we have the opportunity to really generate alpha. So when I talk about active management, I'm not just specifically talking about where we can generate alpha on the public equity book, which is where a lot of the airtime gets spent. I'm talking about active risk budgeting across programs that all have an opportunity to generate dollars value add, dollars to pay benefits. And so when we transition into this next phase together as a team and with the board, we're going to be talking about how do we take our entire active risk budget, how do we slice that up across the different relevant asset classes and strategies? How do we set metrics for what we need to expect to get a return on for that active budget? And ultimately, what is the value add of dollars, the real dollars in our pocket that we can pay benefits with? What does that look like? And are we getting paid appropriately? Are we being held accountable for that risk? And so they're different. They're different concepts. Certainly on the private market side, that active management is more expensive, but hopefully you get more bang for your buck in that area because it's a different thing altogether. Our job is to make sure that we take a look on a relative basis at all the opportunities we have to generate alpha, to make sure that we're getting paid for all the risk across the spectrum. And right now, the way that we're set up, our behavior, our culture, our framework isn't focused in that way. We look at it as, where have we beat the benchmark? I'd like to start talking about where are we adding dollars to the genes, the benefits genes, to start paying benefits. And it's just a very different approach, and it's one that, again, takes a bit of a cultural shift, and it'll take time, but that's the direction I'd like to take us in.
Thank you, and certainly we wish you well in that culture.
I'll need your support. So.
Absolutely. Thank you, Mr. Chair.
Okay, thank you. And we go to Director Lisa Middleton.
Thank you, Mr. Chair, and thank you, Nicole, for this presentation. Very helpful. I want to go back to your discussion on private equity. And the lost decade, and I'm repeating what I think you've already said, was 2009 through 2018. And certainly looking at the last few years, from this board, I have seen a very strong commitment to private equity as a class. Yet, if I listen to what's happening outside of this dais, there remains considerable, if not misunderstanding, regarding the value of private equity, substantial resistance to continuing a strong investment in private equity. Please describe for us what you think our strategy should be going forward. One, to better educate the public regarding the importance of private equity, but two, and most importantly, to better insulate CalPERS from engaging in the kind of destructive practice that we engaged in between 2009 and 2018.
I love this question, and I could spend all day on it, so I'll do my best to be brief and hit the important points. So I think, first off, I think in the last few years, under Greg's direction and the support of the team and the board, we really have turned around not only the program itself by deploying capital, but just really the attitude and the approach, our approach with partners, the perception partners have of us of being a good partner, our agility, our in-house governance around it, et cetera. So I think that is something you've observed, and I think that's all good news, and it's a great starting point. I think private equity is an asset class, especially heading into kind of this new era that we're about to head into, actually provides for tremendous opportunity to CalPERS in particular, and I'll give you my thoughts on why. Number one, the team's done a very good job at choosing partners that are real value creators. When I look at the list, even up to the most recent partners that we've been doing diligence around, it's almost like old school private equity investing for the most part. A lot of value exposure, a lot of teams that have in-house value creation. And why is that important? Well, it's important because I think in this new era we're about to enter into, it's going to be the old plain boring type companies. Cash flow is there. You understand how margins can be improved or not. That's where I think real value is going to be added in this next era of where we are with inflation, where we are with interest rates. And so I think the team is doing a good job, has done a good job of constructing a very diversified portfolio that isn't just growth focused. In fact, we're light on growth, and we're almost trying to think about how do we make that balance between going from what's been historically more of a value lens, if you will, to a growth lens. The second thing I would say is, in spite of ourselves, we actually have more room to do more in private equity than some of our peers because we were late to the game. And so it's a bit of a interesting way that we've landed here, but there are many programs around the world that find themselves over-allocated, not so much to their private equity programs, but to their illiquid programs. And so there could be an opportunity for us to backfill old vintages by picking up secondary buys of programs that we get to do the work and the analysis to decide how does that fit into our puzzle. And I think that that's a real opportunity, and not just with private equity, but all of our private market programs, real estate, certainly private credit as well, and infrastructure. So I think that's all helpful. I think the other thing that's happened in the last few years is our reputation for being a good partner. And, what defines a good partner? Well, we give quick no's as much as we can give a quick yes. We demonstrate our in-house capability as being, strong, thoughtful, decisive. I get feedback all the time on our team that are looking at co-investments that is the level that's the quality that we are now being perceived in the market. We're being perceived as being true thought leaders on ESG integration into our program. We're being seen as true thought leaders on human capital management. And so when we start to build our reputation about being forward thinking, where the ball is going type partners in private markets, that's just going to open up a tremendous door for us, in particular into co-investing. And that kind of brings me to the next point, which is our real opportunity now is to take all those lessons learned and take all those great partnerships that we've been building on in the last, few years and really start trying to drive our co-investing program. We're one of the few plans on the globe, frankly, that can show up and in a thoughtful way with appropriate governance and risk oversight, show up with large equity checks to help get some needle-moving opportunities in the market done. And if you combine the fact that we've improved our reputation, if you sprinkle in some of the asks that we're coming forward and having a first read on that help us be deemed a bit more agile and give us a bit more flexibility, we're suddenly in a position to become a first call on some of these really needle-moving, from a scale perspective, opportunities that actually do start to move the needle on a 450 to 500 billion program, which is a very unique challenge that we have. Our size alone is, gives us a whole other set of unique constraints or, difficulties at times. And so overall, I think that if we start with we're going to be sustainable investing partners, and we start with the fact that we have a reputation for being good partners, we can be agile, we can be thoughtful. If we layer in the resources and be thoughtful in making sure that we have the right tools in our toolkit, and we leverage the expertise of outside partners when needed, I actually think, Lisa, we're in a really excellent time to be deploying into the private markets space overall. And I think the team's done an excellent job at repositioning private equity, real estate, and infrastructure over the last, call it, 5 years.
Thank you. Very helpful. I want to change focus just a bit. I appreciate looking back over the last decade, but that begs the next question. What is the next decade going to look like, and how is it going to be different than what we've experienced over the last 10 years? Are there particular asset allocation classes that you think are more likely to be different? How do you approach raising the question, what should we be doing differently going forward?
Yeah, I think I'd go back to some of my earlier comments just around where I think where we need to be thoughtful about spending more time, I guess you'd say, is really more on the value side of things versus growth. I think we've all benefited from this turbocharged decade of growth and growth assets. I think we're going to want to spend a lot more time in the roll up your sleeves category, meaning we're going to want to look at more value plays. We're going to want to look at partners who actually have to go in and do something, do different. We're going to want to make sure that our own monitoring approach internally is best in class. When, things are flying and everything's rising and everyone's making money, you can, at times it's easy to forget that momentum or that consistent approach to making sure we're doing what we think we're doing, we're getting paid for where we think we need to get paid, we're getting paid for the risk, is really important. And so part of our total fund homework right now is making sure we have our own monitoring approach in place that's best in class across the asset classes. And so I feel very good about where we are with liquidity. I feel very good that we haven't even unleashed this different approach to looking at value creation or value add or thinking about risk budgeting and getting a return on that risk. It's a whole different approach that it's going to be a lot of work and it's going to be a big culture change for us, but this is a very good time for us to be doing it. We can leverage partners that we already have. We can start deploying a lot more capital into co-investing, and we can start, we are going to have a reputation as being an employer of choice because not only of our culture, but because we're doing things. And I think for the next little while, certainly on the private market side, as I mentioned earlier, a lot of groups are kind of a bit on hold right now because they're over allocated. We are in the opposite place. So if you want to come and learn alongside some of the smartest minds in the industry through our partners, and even with the talent that we have in-house, we're going to become an employer of choice, and I really believe that.
Nicole, thank you, and always be coming back to us and telling us what you need to help you.
I appreciate it. Thank you.
Thank you, Mr. Chair.
Thank you. Next, we have Director Pacheco.
Yes. Thank you, Nicole. Good morning, and thank you for your presentation. I really appreciate it. Also, thank you, Chair Miller, to allow me the opportunity to have a few questions. So my first question is actually on the last page of your presentation, page 16, on the path forward. And I just want to know, how long do you think it would take to have this change, this culture of resilience and innovation in the total fund to bring it to fruitness? Because I see your point and how it's important, because it actually gets central to being successful is having this culture. But what are your thoughts of the timeline, and have you even thought about where we would go from there? That's my first question.
Well, I think the good news is that we're already well on our way in some of these areas. A lot of it's cultural change, right? So sometimes, opportunities will present themselves that I didn't even realize would create a spark in getting folks excited about innovation, for example. The fact that we now come together weekly and discuss any needle-moving opportunity of size, despite the fact that we have all kinds of delegated authority at the MID level to do, interesting things, we've put that aside as far as having the dialogue and the conversation and being in the room. I think that's going to end up having all kinds of ancillary benefits that I didn't even imagine on culture, on risk appetite, on feeling, supported. I think the fact that we're really trying hard, and I'm really appreciative of the engagement of the board. We're really trying hard to engage with you, and you are showing that you are engaging with us. That alone, if I don't have to be worried that that I can't talk to you about something openly and say, I just took a look at the last 10 years and these are the things that are on my mind. If I didn't feel like I could have that open dialogue, that would set us back. we're in an opposite place right now. We're coming forward to you. We're saying, here's where we really think we need to go. We need your support. I've heard on a number of occasions, if you need resources, whatever you need, Nicole, tell us. But then it's on me to share with you where I think things are going sideways, or I'm worried, or I think there are concerns, or if I feel that we're going down a direction through the risk lens that I don't think is going to get us where we need to get to. Or if I feel like we're being too aggressive in another way and I'm worried about that we don't have the resources in-house to do it. Having that open and transparent dialogue with you, I think, is what's going to make executing on this something that will exceed our expectations. So I wish I had this specific timeline. I like to think in 2-year chunks. I kind of think first year, get it up and running, second year, see it humming, third year, it's on its way. So I think of it as the first, couple years. I'd say we're right on schedule. I've had tremendous support from the team. As I said, we're getting good traction in the market on some of our key hires, and the interactions that we're having with the board have exceeded my expectations. And so, I think to build an in-house direct deal doing program, that's a 10-year journey. I'm not going to pretend we could bring everything in-house. And when I say 10 years, it's between the systems and training up the people. But in the interim, in very short time period, as in like from year to year, we can be doing a lot of interesting things with strategic partners. We can leverage the in-house capabilities we have and buffer them with the outside expertise, safe pairs of hands, smart eyeballs around the table. There's so much that we can be doing given the liquidity position we're in, given the authority that we have, and just given the opportunity set that's right in front of us. And so, again, once we're through this board meeting, I'm excited about our next few board meetings, because I feel we can turn from where have we been to some of the really exciting things that are in the pipeline for where we'd like to go.
That's great. I'm really impressed with your enthusiasm and optimism, and I'm very optimistic as well. In terms of having the information on hand for us at the board to understand at a very high level, on page 3, when I looked at the realized 10-year Sharpe ratio of 1.0, which is, it's okay, but do you think that we need to develop more robust metrics, key metrics for us to kind of evaluate we are? Because the Sharpe ratio certainly takes into account the returns relative to the investment risk, and I'm just curious what your thoughts are on that.
Yeah, I think what you'll start to see us talk a lot more about the active risk bit, so more on the information ratio. You'll start to see us being a lot more focused. Are we getting paid for the risks that we're taking, and are we taking the risks to begin with? So absolutely, there will be a lot more focus on those types of metrics going forward, and I will be holding myself and our team accountable to make sure that we're sharing with you our journey, but certainly that internally, that's how our brain starts to think. Are we taking the appropriate amount of risk? Are we getting paid for that risk? And how do we compare?
That's excellent. And so that leads me to another question about risk. So CalPERS has used some long-term treasuries, fixed income, as an inexpensive risk mitigation process. In recent AOM cycles, should CalPERS consider other ways to mitigate risks in the public markets, for instance?
Yeah, I think what our team has been talking about now, and there's a bunch of bodies of research already going on, is the last 10 years isn't going to look like the next 10 years. So tools that we would have used historically, we can't assume we're still going to use. That doesn't mean you throw things out and assume that it's just a whole new game. There are many attributes of all of our programs that should remain, but then it's just a matter of balance. Are there other areas we can be allocating to through that risk mitigation lens? Mm-hmm. The answer is most likely yes. It's just a matter of us figuring out and making sure the governance is around the decision to, as well as the decision not to do certain things. And right now, historically, as we saw, it's been quite a siloed decision-making process, and now it is no longer siloed. It is done in a more holistic way, taking into consideration what every opportunity that we have, that we're balancing liquidity, we're balancing risk, what are the trade-offs? Right. And so you'll start to see us come forward with different ideas for risk mitigating strategies as well as growth strategies.
I look forward to that information. That's going to be very exciting. Thank you very much.
Thank you.
Thank you, sir.
Thank you. Our next question comes from Dr. Willis, who's participating remotely.
To others.
Yeah, we certainly can. I'll have Sarah come forward again. She's the expert on the team in that area in particular.
Thank you.
Sarah Core, real estate. The the opportunistic is riskier because it is an example would be buying land and getting it entitled, and then building a housing development, building an office building. So there's lots of risks in that. Whereas the core is buying an existing building that's fully leased and therefore has less risk to it.
Okay, what about in terms of high-level debt? Do you encounter that as well?
Opportunistic would have more debt on it as well, correct?
Right. Okay. Thank you so much for the clarification.
Okay, thank you. And we're back to President Taylor. Oh, let me try it again. There you go.
Thank you very much, Chair Miller. So I had got brought up some time ago, so I'm going to circle back to what Ms. Yee was talking about. And Nicole, you brought up the fact that you're going to be integrating the Sustainable Investment Group into the investment office, and I have concerns. I think I've voiced them to you before, but also here's my concerns. We have a well-oiled team in James and Travis and Tamara. So I just want to, and they're working really well with stakeholders, extremely well on the S, on the ESG, right? And I know Marcy participates a lot in the climate change events that are important to CalPERS and other events that are important to CalPERS, DE&I events, et cetera. But I'm concerned in that the last time it was integrated into the investment office, there was a loss of agency from the Sustainable Investment Group. So I want to make sure that these folks are still able to do their work with the stakeholders that they currently engage with all the time, as well as implement our goals. And one of the things I see, and I know you're brand new, so it kind of came to a screeching halt, but one of the things I see that didn't happen was last year, when Ms. Simpson was still here, we were working on having a new 5-year ESG strategy. Well, that is nowhere to be found at this point. I don't know, we haven't heard a report on the research or anything. And I know we need a new head of the program, et cetera. We have an interim head. But I just want to make sure that this important piece of work that you recognize that we are so world-renowned for is still autonomous and has the agency it needs to do the job it needs to do, that the board has asked it to do.
Yeah, thank you, Teresa. Absolutely. I think that's top of mind for Marcy as well. And as a result, it's top of mind for myself and would have been. I think my idea of bringing the position over to investment was, frankly, there should feel no change. If anything, it should feel we will still all benefit from the incredible work being done by the current team. That isn't going to change. I think what does change, though, is my team within investments. We all know that if each and every one of us is not a success in our individual business objectives, then we're all going to hold each other accountable for just not being a success overall. And the challenge of having such an important role of sustainable investing not residing within investments, it doesn't allow me to hold every single one of my team members accountable for its success. And right now, the way that we've set ourselves up by having these 9 business objectives and by having elements of the sustainable investing piece a part of those 9, if that mandate is not a success, then we've failed as an investments team. I can't have that same expectation of my team if it's not. This was my rationale for wanting to have it within the team. And so my hope is that you'll start to see that, and hopefully again by November, you'll see some, great movements we've made in some of these programs. We're very close to announcing some really large initiatives that'll make us feel really proud, not only to ourselves, but in the market for some of the things that we can do that really move the needle in some of these areas of emerging managers, diverse managers, et cetera. As one example, you'll start to see that we're much sharper focused on integrating ESG across all our asset classes. We've got a huge body of work that has been ongoing with some of our partners. Well, why isn't it with all of our partners? I mean, it's hard to get to all, but in theory, by having it reside within investments, I just feel like 1 + 1 will be 10. So that's my hope, and that was the intention of bringing it and really making it an absolute necessity to see it be a success. Otherwise, none of us are a success on the investments team.
Great. And so I'm assuming then that the accountability factor for each of the asset classes, you'll be working with them on that to make sure, as well as still, I don't think you really answered to the agency part of our folks that are currently there. I get integrating it, right? And making those folks accountable, but making sure that the team that's already there has the agency necessary to do their job.
Yeah, no question. I mean, that can't suffer at all to meet the needs of what we're trying to do with weaving sustainable investing into the rest of the organization. There's a body of works that go on that don't really have the eye in investing, but they do. At the same time, they do. And so what you've seen and what you've been working with and what the board has felt real benefit from, I hope only is amplified. And that would be the intent. And I'd like the feedback if you're feeling that it isn't, because the intent is to make sure that we're seen as world-class for all aspects of what we deem sustainable investing initiatives.
I appreciate it. And then one last question. For some odd reason, I thought that there was going to be a research arm to this. Was I wrong? Is that the case? So you're going to have...
Yeah, I'd love to fold in research in many ways. Research around the risks in our portfolio, research within the investment opportunities, and risk just within topics on how we can be seen as global leaders. Again, these things take time and they will require resources, and there are pockets of all of those things already happening. It's just a matter of pulling it together and being a lot more consistent in what we're doing and how we're reporting it to yourselves and our stakeholders. And in addition to that, we have a whole communications team now that's just focused on making sure we're communicating well on all of these activities and more. And so we're really trying to tackle it from a few different angles.
You mentioned a bunch of stuff. Number one, we should be telling our story always. And number two, I look forward to this new governance to see how that works within our investment office and get things moving and succeed in getting your goals going. So I appreciate all of this. Thank you very much.
Thank you.
Okay, thank you. I see no more requests from the board, and I really appreciate the dialogue and the material and the presentations and kind of the thoughtful approach you've taken to bringing all this together in a way that helps us not only see where we've been, but have a kind of an encouraging and confident look forward to where we may be able to go going forward. At this point, I'd like to invite Mr. Jerry Fontaine from CSR up. He's asked to comment on item 5A, and if you'd come on up, I'll give you the floor.
Good morning, and I appreciate this opportunity to speak to the board. I may be less generous with my comments than past speakers. I feel that we haven't done well over the last 10 years. Other organizations operating in the same investment environment have done much better. And looking at the lessons learned and the path forward, I believe that this path forward should have been an everyday job description of our investment staff. Obviously, these things they know about, but the implementation has been lacking. I'd be more confident sitting here today if I heard a little bit of how these steps were going to be implemented, rather than this is what we plan on doing, and I'll sit here 10 years from now, luckily, and hearing the same thing. This is what we need to do. This is what we want to do. How about telling me how you're going to do it? So possibly, and this is critical on my part, but possibly the board needs to provide more oversight to the investment staff and possibly take the step one forward and reevaluate the qualifications and philosophies of your current staff members. As I said previously, other organizations have operated in the same investment environment, have done better than we have, and there should be a reason for that. And this report, as submitted, is a great report, but I take it just as a justification of poor performance. Thank you.
Thanks. And I introduced you, but if you would introduce yourself for the record. So.
Oh, I'm sorry. Jerry Fontaine, and I'm speaking here as a private person, as the stakeholder of CalPERS. Thank you.
Thanks very much. Okay, I think that covers it for 5A. And
one more speaker.
One more speaker for 5A. Oh, no, that's just, okay. Okay, I will ask Terry Brennan to come on up and speak on item 5.
Good morning, Mr. Chair and members. Terry Brennan on behalf of SEIU California. Happy to be here on this rainy day. Really happy to hear the comments of your new CIO. I think we're moving in the right direction. However, I have to agree with Jerry from CSR. My members are really disappointed in past performance here at CalPERS. We have been told that we had to de-risk the portfolio for the downturn for about a decade. We've been in the process of it for at least 5 or 6 years. During that process, we underperformed every one of our peers on the upside, all with the promise that when we got to the downside, we would be better protected than other funds. We would be better protected against a down market. Well, now we've had the test, and granted it's only 1 year. I understand ups and downs, but in the test of a down market, we continue to underperform our peers. And that's a huge disappointment for those of us who believed that this was a strategy that was going to be successful. And it's turned out that shadowing a benchmark is not going to be acceptable. What we have delivered for our members and our agencies in terms of performance is well below the expectations of this organization, this board, this investment office. And I look forward to working with Ms. Musico in the future here on changing that dynamic, restructuring our thinking process so that we're not stuck in this mode of constantly underperforming our peers and still delivering something near a benchmark. You're going to be talking tomorrow about, or later this week, about performance bonuses and incentives. I'm not seeing any value added. just chasing the benchmark is not delivering for our members. It's not delivering for your board. It's not delivering for California. And I'm looking forward to changes to make that better. There are a few other things that weren't mentioned that we need to consider, including accelerating our reach toward net carbon neutrality. It's time. We have to up the program. When you've got 200 fossil fuel investments and you've got 2 of them incorporate carbon capture, that's not good enough. Also, your outside investment team
I think
less diverse than they need to be. Thank you for your time.
Yeah, thank you, Terry. Okay. Okay, I think that does it for that item 5A. And moving to 5B, which is revisions to the total fund policies.
Thank you. We're just having some of my colleagues come up to participate in this part of the agenda. Greg, Sarah, and Amy are joining us at the presenters table. So this is really a first reading of some of the potential changes that we'd like to discuss with you around our investment policies. And it ties back to some of the conversation we were having earlier about ways to make us more agile, both internally but also perceived through the eyes of our investment partners. Certainly as we're about to embark on this era of opportunity to be deploying more capital into co-investments, for an example, having a few more tools in our toolkit and updating some of the policies to reflect the size of the programs, the strategic asset allocation, execution requirements, just to get to that execution point. There's some suggestions and some history, and hopefully by the end of this presentation, the rationale will become a lot clearer, that it's more about making sure we're agile, it's more about fine-tuning and right-sizing for the size of programs that we have and for the execution of the strategic asset allocation than it is about anything else. And so with that, maybe we could flip to the next page. So again, we'll have a policy. I'll do a quick overview of the why we're here today and what we're asking for. And Greg and Sarah and Amy will go through different updates on their program and how that relates to these policy requests. And Amy will walk through the policy changes. Next slide, please. So the punchline here is that the new strategic asset allocation requires significant deployment of capital. As you know, in November, the board approved a new SAA, which included increased allocations to private equity, real assets, and private debt as a new strategy overall. And today what we're asking for are some policy changes just to help us get to that end game. In some cases, it's about more flexibility. We've got broader deal sources, and we need a wider filter to capture attractive deals. We need more agility to capture those deals. In other cases, we're just looking to refresh historical levels that would have been granted to us, established at significantly lower NAVs of those programs. Next page, please. So before we launched into that, I thought it was important just to spend a bit more time on this new governance model. I know I've touched on it a few times, but I think it's really important to give the board comfort that whenever we're talking about policy changes, it can lead to perceptions that may not be accurate around giving us more flexibility without the appropriate amount of oversight, for example. So I want to make sure I just touch on that head on. When I arrived and did my walking tour, I delivered to the board and to the team this notion of innovation needs to be at the core of everything we do. We need to be having a lens on resiliency, just given where we are in the markets from now and going forward versus where we've been. And so we kicked off the second stage of my listening tour, so starting around 90-day onward, with the establishment of these 3 governance committees. And again, the point wasn't to create bureaucracy for the sake of bureaucracy. It was really trying to drive a few things. Number one, we have 9 business objectives, and I want to make sure I do everything in my power to make sure we execute on those objectives. And so we need forums in place to make sure we're doing the work we said we were going to do. The second piece is we have a number of the business objectives that we've laid out are more around the people and culture bits. And so we needed a forum to make sure that as the CIO, I was getting frequent updates and that the team was being held accountable in a forum amongst each of us, our peers within our teams, that we're being held accountable of getting that work done. The third piece was we've talked a lot about how we have this massive opportunity to be thinking through a return on risk perspective, a risk budgeting perspective. Yes, there's a very important policy piece that is around a benchmark, but more importantly, to get us to the end game of being able to provide benefits, we really need to look at whether we're getting paid appropriately for the risk we're taking. And so having an entire forum dedicated to these risk initiatives, the portfolio construction initiatives, new strategy initiatives, to some of the earlier questions of, are you going to do different things? We've created the Total Fund Management Committee so that we can have weekly discussions with the right individuals around the table. It's a combination of myself as chair of each of these 3 committees, as well as the managing investment directors, as well as the investment directors or others who run the day-to-day functional operations of each of these relevant teams around leverage and liquidity monitoring, risk management, et cetera. And finally, the third committee is an investment underwriting committee. And again, we know that we are very fortunate to have the delegated authority from the board to make investment decisions across the board. But what I wanted to ensure as CIO is that I was in the weeds enough to know exactly what was going on within each and every program, to make sure each of my team members were aware of what was going on in each other's programs. Because again, if we don't have a total fund perspective, if we're just making decisions in silos, we're not going to get to where we need to get to. So the point of the investment underwriting committee was to make sure that everything from investments at a certain dollar threshold, partnership or exposure at a certain threshold, important proxy decisions that are being made that could impact us from a reputational perspective, that where we can really move the needle, for example, are all floating up to this one committee on a weekly basis. And finally, the business objectives that have everything to do with investing and investing better, those working groups come forward and present to this investment underwriting committee. So hopefully, you know, the buzzwords of people, portfolio, processes, and performance start to take on a real life. They're more than just buzzwords because they feed into everything we're doing through those 4 pillars is showing up, and we're being held accountable for action and momentum being made in these business objectives within these three committees. We can go to the next slide, please. And so really it's about giving you all a sense that the oversight continues to get stronger and stronger. This graph is just to show that there are 6 teams, including board consultants, that regardless of where we land on some of our policy requests, there are 6 layers, if you will, of every decision that we make. And so the oversight absolutely remains intact. This is just about flexibility and keeping up with the size of our programs. Can we go to the next slide, please? The final piece I wanted to just to tease out for all of you before I hand it over to the team is that as we're requesting to have more flexibility, again, there's this built-in oversight, if you will, through our deal pipeline information and our post-closing information. And somewhere in the middle, we touched on it a little bit, but we haven't previewed it for you, but it's in the works, is having a more consistent approach and dedicated approach to monitoring of our portfolio. And so, again, with the request and this first reading of these policies, we just want to make sure that you walk away understanding that there's more governance in place, that there's 6 levels of oversight in place, and that each and every deal that is coming through the walls, and when I say deal, I mean partnership or an actual co-investment, each and every single one of those opportunities that we're looking at comes through the committees, is tracked through our deal pipeline information. We have our compliance team that is overseeing that as well. And when we close on opportunities, we have this ongoing monitoring approach that we are spending a bunch of time improving and making sure we bring up to best in class. Next page, please. So with that, we thought it was important to make sure that we really walked you through the specifics of the programs to give you a better sense of the why we're here asking for policy changes, because again, depending on the program, there may be slight nuances, but we hope after the presentation we can get into any questions or concerns that you may have with the requests that are being made in this first reading. So with that, I'd like to transition to Greg to discuss the private equity program and the changes that we see there and the requirement for our asks.
Terrific. Thanks, Nicole. I wanted to take a few minutes to provide some context on the growth of the private equity industry over time and the implications on our private equity program. So here on this slide, we lay out global private equity fundraising over the past decade. This is the amount of capital raised each year by private equity funds to invest in private companies. Now, because this capital is invested over a multi-year time horizon, the total amount of capital that could be invested in private equity today, which is commonly referred to as dry powder, would be larger than the amount shown here. As you can see in the graph, the amount of capital raised by private equity funds has increased significantly over the past decade, increasing from $150 billion in 2010 to $750 billion in 2021. As the capital raised has grown, so has the number of larger transactions completed each year. On the next slide, we show the data on the evolution in transaction size over the past 15 years. The light gray bars show the percentage of transactions sized below 100 million, and each bar above the light gray bars shows progressively larger transactions. Over the past decade, there has been a significant shift to larger transaction sizes. This has direct implications for our co-investment program, creating a material expansion in the co-investment opportunity set, both in the number of potential opportunities as well as in the size of opportunities offered to us. Co-investment is the primary lever we have for increasing the cost efficiency of our program, given that co-investments have limited to no fees or profit sharing. As the co-investment opportunity set has expanded, it has created a larger set of potential investments for us alongside our high conviction partners. On slide 10, we show CalPERS' historical annual private equity commitments. As the private equity industry grew substantially over the course of the past decade, CalPERS did not scale our commitments relative to our total fund size, averaging annual commitments of $2.7 billion from 2009 through 2018. We have since begun methodically scaling our capital commitments to private equity with a longer-term goal of committing approximately $15 billion per year to ultimately reach our 13% strategic asset allocation target. Over the past 4 years, we have methodically increased our average annual commitments, and we are now in line with the longer-term average pacing we are targeting. We are, however, continuously working to increase the quality of our private equity exposure by shifting more capital to our highest conviction opportunities in both managers and companies as we look to leverage our scale as a competitive advantage moving forward. I'll now hand the presentation over to Sarah to touch on real assets.
Thanks. Next slide, please. The infrastructure market has grown significantly over the past 10 years. While the average deal size for the entire market is $750 million, it increases to $2.5 billion for deals over $500 million, the target market for CalPERS. Additionally, the size of the market is expected to grow. The energy transition alone will create massive demand for new infrastructure. According to a recent McKinsey report, to get to net zero by 2050 will require $3 trillion per year in new capital spend. Next slide, please. The real assets team has focused on building out an infrastructure portfolio over the past 2 years and has made good progress. The portfolio grew from $4.8 billion in June of 2019 to $11.6 billion in June of this year. However, to meet the new strategic asset allocation targets, the infrastructure portfolio needs to triple over the next 3 years. Doing this effectively and efficiently will require CalPERS to commit larger dollars to each investment. Next slide, please. As the commitment limitation has remained constant and both real assets and the infrastructure portfolio have grown, the limitation as a % of the program has come down. We believe it would be prudent to increase the limit to be consistent with what the real estate program can do. Next slide, please. Infrastructure investing is more predominant outside the United States, and deals can be lumpy. One large transaction outside the United States could have a material impact and change the exposures. As a result, we would suggest that increasing the policy limit on international within the infrastructure portfolio, but leaving the limit the same at the real assets level, will give more flexibility in investing in infrastructure outside the United States. And I'll turn it over to Amy now.
Thank you. And now I'll talk about some of the specific, the 4 areas of policy changes that we think are necessary to carry out the board's strategic asset allocation decision. And we would really like your feedback today for this first read. Next slide, please. Oh, sorry, same slide. Wait, no, next slide, thanks. Okay. So regarding staff delegation limits, so first we're requesting higher staff authority limits given that the plan's assets have increased as well as the target asset allocations. In most cases, this is simply a refresh of our prior limits, and more on that one to come. Next, we'd like to establish deputy CIO limits between the CIO and the asset class heads that were the managing investment directors. Third, we've added secondary sales of funds and CIAs to the delegated authority structure at $2, $4, and $6 billion for the MID, DCIO, and CIO, respectively. Lastly, we think that, Nicole spent a little bit of time talking about the Investment Underwriting Committee. We think that the IUC, as we call it, the central decision-making would replace the limit on any one program head's fiscal year spending. Next slide, please. And when we think about updating staff delegation, there are conceptually 3 factors that influence delegation limits. First, the size of the total fund, which we know has gone up. Second, the allocation to the asset class, which again has gone up. And then any shift to the business model. So when we think about co-investment as a strategic initiative, this is where the shift comes into play. So in our case, we have all 3, and the path to the new strategic asset allocation is to write larger checks, and we think we need higher delegated authority to get there. Next slide, please. So what you see here in these charts is that delegation limits for funds and co-investments as a percentage of the private equity program are at all-time lows. When the prior limits were put in place, they were contemplated relative to the asset class NAV at the time. However, private equity has grown quite a bit without concurrent scaling and delegated authority. In the left chart, you can see on the green arrows where we've proposed setting the new delegated authority limit. It's below the orange arrow, which is what is the 27 ALM cycle, where where delegated authority was in 2017. So, still below our historical delegated authority, and this is for funds. When you look on the right-hand side, that's for co-investments. We are again at all-time lows. However, in this case, we are asking for higher delegated authority, and you'll see that on the upper right, that green arrow up there. Greg has described that co-investment, as Nicole has as well, is a strategic priority for CalPERS, and the team will need to write larger checks to achieve scale investment and scale co-investments. Just for general awareness, in the last 2 years, the private equity team underwrote upwards of 50 co-investments, and if we want to continue to scale that program, it will be important for them to be able to commit larger dollar amounts in addition to executing larger volume co-investments. Next slide, please. So for infrastructure delegation limits, they are also relatively low versus historical NAV. We are proposing limits. You can see, again, the green arrow, and it's very aligned with where we have been in the past and where we were in the last ALM cycle. And then just for some background for real assets, it was only 3 or 4 years ago that the team was committing $1 to $2 billion annually across 3 or 4 total infrastructure commitments. And by comparison, we're on track to do about $7.5 billion this year and 12 commitments for this fiscal year. And the only way that we think we can keep up this pace is to write larger checks when we have high conviction. And this will require higher delegated authority as well. Next, switching gears, next slide, please. We also wanted to talk about prudent person opinions. We are also recommending increasing the thresholds for PPOs, as we call them. Much like delegation limits, PPO thresholds should be updated given the growth in the NAV and the strategic asset allocation targets. When the prior thresholds were put in place, they were contemplated relative to the asset class and NAVs at the time and the target allocation. The new thresholds that we are proposing represent a deal size that is larger, and larger deals come with longer lead times, so that allows us the time to get the PPOs. On smaller deals, you often will have less time, and therefore, if we are required to get PPOs on smaller deals, it could eliminate us from certain opportunities that we would have otherwise liked to take advantage of. And just thinking back from Nicole's slides, PPOs are one of multiple ways that we approach governance around decision-making, and we feel that we have the right governance today to warrant higher PPO thresholds. Also, given that we have a new private debt program, we established prudent person opinion thresholds for that program. Next slide. So now with respect to the private equity program, there are some additional requests to change policy. So first, we're looking to broaden the sources of deal flow. Nicole spent some time talking about establishing strategic partnerships and investing alongside them. If we can have the ability to invest alongside institutional investors that we do not currently invest, it will give us opportunities that we do not currently have and that we would like to use our competitive position to take advantage of. Second, there are 2 proposed changes that will help private equity's ability to scale. First one would be increasing the committed capital limit per general partner from 10 to 15%. This is consistent with an exception that's been already granted for 3 of our larger general partners. The second is to increase our percentage per fund investment limit. So currently our limit is at 25% of any given fund, and we would like to increase that to 35%. Lastly, we would like to modify the private equity strategy targets to better reflect our goal of diversifying the portfolio across middle market growth and venture segments. And next slide, please. And then for the real assets program, you saw in Sarah's chart that international is becoming a bigger portion of the infrastructure market. For the real assets program, we would like to we'd like to modify the infrastructure geographical limit with a shift towards international. And with that, we would like to open it up for questions.
Thank you very much. Appreciate the presentations, and we'll start off questions from President Taylor.
Oh, thank you, Chair Miller. Hold on a second. I want to make sure I've got the questions. I'm going to start with the global infrastructure RA. It looks like we're going to be delegating outside the U.S. So is that where most of the deals are? Is that why, Sarah, you were talking about that?
Correct. The, international makes up a larger part of the infrastructure market than the U.S. does. Currently, it's a 0 to 60% international,
okay.
And we'd like to take that to 0 to 70% international. The deals are just very lumpy, and so one deal can, change the portfolio significantly enough, and we just want that extra room so that we don't violate the concentration limit.
Okay. And then I had a question, page 18 of the 25. So, I need to go back in a second, but also, let me get to 18. I just want to make, so why do we need the increased limits, the larger amounts? I think I'm concerned because we've given you guys a lot of authority, and given where we have been, I want us to be able to make great returns. I want us to be able to do the things we need to do. But on the other hand, given the 10-year history we've had, I'm wondering why we need to increase these amounts so much. These are significant increases. So I don't know who wants to answer that. Nicole?
Yeah, I think, Teresa, it's really a reflection of the market opportunity that is in front of us, the ability to move the needle because of the size of our programs and overall program. It's really it's a practical ask. It's an agility ask. It's our ability to speak for the dollars. A big part of us being deemed a partner of choice, if you will, is that we can give comfort that while we will give no's maybe as much as we give yeses, that we can speak for the dollars without having risk, that we could get along really deep in the weeds on a deal alongside a partner only to create risk in that process for them, that we could be deemed not able to speak for the dollars, if you will. And so a lot of this is just about us having a bit of flexibility to line up with the size of programs that we're trying to execute on, the size of deals that we're seeing that are most likely to be coming in the door, that makes sense for us to be doing in order to move the needle.
Okay, so one of the things we were always told is that we were such a large investor that it was hard for us to do deals, especially in PE and real estate, because we can't participate in these smaller deals. So now you're saying there's lots larger deals. So is that, and then we're going from, we're going up 1.9%, 2.4%, from 3 to 3.2, which that's not hugely significant. I just want to make sure we're giving you the appropriate authority, but at the same time, we're not just chucking our authority away.
No, understood. Yeah, look, it is from your perspective, it would be a delicate balance. From my perspective, I'm just trying to position the team to be deemed as agile and be able to move with where the market's going. We've had a number of calls, as I said, in the past few weeks from other institutional investors that are finding themselves in a bit of a pinch because they've well exceeded, because of the denominator effect, their allocations to their private market programs overall. And so, you get those calls, you need to be able to be agile and move within a time frame that's competitive to where else they could go to get a quick yes with real conviction that we could speak for the dollars. And so by having the ability to speak for these larger thresholds, it just puts us in a much more competitive position to meet the needs of what our programs require to execute on the SAA. So it's more of a math issue of how do we get there? Well, we're going to have to write larger checks. If we write larger checks, we're going to have to look at our delegated authority levels. We're going to have to look at some of the things that are wrappers around our decision-making capabilities. So you'll see in the language things like can we have the flexibility to do deals with non-GPs? Because technically today, when a Canadian pension calls and says, would you like to come in alongside us in our private equity program, our real estate program, our infrastructure program, as it sits today, they're not deemed a general partner. And so we just don't, practically speaking, have that flexibility. So we try to look through the lens of, is there anything in our policy today that prevents us from being agile, prevents us from being able to execute where we need and how we need and with the agility we need to get to the SAA? And so that's really the theme that we're trying to put upon you to consider.
Okay, so that makes sense. And then I want to kind of pivot to how does the new governance structure help us feel comfortable that we're giving you this extra money? Does it actually give some more checks and balances throughout?
I think checks and balances is a great way to articulate it. I can give you an example. When I first arrived on the scene, within the first few weeks, we were, because of the timing, Sarah's real estate program was coming forward for approval. And Sarah would have benefited from the 6 layers, between board consultants and our own in-house lawyers and our own team, et cetera. But at the end of the day, that decision was really, for the most part, being done, frankly, quite siloed. What these new governance committees do is put a real check on, okay, if we do that over there, if we execute on that partnership opportunity, where's the opportunity lost elsewhere? What does that mean from a liquidity perspective? What does that mean from a risk-on perspective? Are they the right partners? If we're doing if we have an opportunity to work with partner XYZ, maybe we've had a negative experience with that same partner in a different asset class. Or maybe more importantly, we're actually in the 7th inning of looking at something with that same partner, and maybe there's a way for us to leverage this broader relationship with them in a way where we can negotiate better fees, better governance, et cetera. So the belts and suspenders of all of these needle-moving opportunities now coming to a single forum where all MIDs are represented, where I'm represented, where the deputy CIO is represented, and we're in that room with both the investment lens as well as Sterling and his team's risk and liquidity lens. We're just putting a lot more belt and suspenders around all of these needle-moving opportunities. And that's only at that level after all those existing levels have already seen the deal. The board consultants, the individual deal teams, they've still gone through the rigor that they've always gone through. This is just an extra layer.
Okay, and then my last question is on the prudent person opinions. Raising that threshold also kind of concerns me a little bit, because I mean that's that other check and balance, right? So I want to make sure that we're not shorting ourselves some expert opinion.
Understood. Yeah, again, I would think of it, we're seeing larger deals and we're trying to do more deals. And so at a certain level, the question you should be asking yourselves is it at a practical level for the types of deals we're now doing? And so if we make that threshold too small, it means that our resources are being used up on deals more frequently on smaller checks when we could be using those same resources working alongside on PPOs where the deals are more needle moving. And so as I see the size of check rising, it makes sense for us to rise with the tide, bring those levels up for the PPOs. Otherwise, we could find ourselves in every single situation for every single deal that Sarah is looking at or that Greg is looking at requires a PPO, and that just starts to become a real, cost at the end of the day, both time, people, resources, and just real dollars.
Okay. I appreciate it. Thank you.
Yeah. You're welcome.
Okay, next I have Dr. Pacheco. See, did it come on? There we go.
Thank you very much. Thank you, Nicole, for your excellent presentation here. So my question is back on private equity. And I was quite impressed with, and let me just go to the slide. There was a slide that Greg put together that showed the private equity industry and deal size growth. So when I looked at this, thank you for interpreting this, how certain deals have shifted and how bigger deals have become more expanded in the marketplace. And that kind of gives me understanding the whole process. What my question is about the diversification at the very end of the presentation, regarding a way to increase our diversification in our portfolio is to move more into growth equity, venture. You know, traditionally we've been in buyouts, and I just wondered what safeguards or what processes or systems we would have in place to make sure that when we do that, we have the right systems in place so that we make and maximize the alpha on those particular deals.
Yeah, absolutely. So I would, visually, I would think about it as a barbell approach, where we have now these committees in place for those big, large, needle-moving deals. They're all going to come through. But part of having our pipeline report reviewed weekly is that we've all agreed as a team that we want to make sure that we put the same rigor around underwriting those smaller, because they tend to be smaller, venture growthy deals as we do the large deals. And so while technically things wouldn't, smaller regular way deals don't appear at this underwriting committee below a certain threshold, if they're deemed or earmarked as venture or growth equity, for example, as a team we're discussing that pipeline every week, and we have the opportunity to say, we know you wouldn't normally bring a $75 million check forward to this committee, but we'd like to get more insight. We'd like to come along for the ride during your diligence on that opportunity in particular. Or for example, sometimes we underwrite funds where we underwrite a family of funds. And so normally the size of check that would be brought forward to this committee is probably the mothership fund and not necessarily the smaller of the family of funds, because it's a venture fund or growth fund. Now with this governance process in place, because we have a relationship threshold as well, we'll have the opportunity not only to earmark some of these venture funds that we'll want to make sure we have a closer look at, but anytime we have large exposure to any one group, any one name, it's going to get vetted again with a little bit more rigor than perhaps historically. And so we're trying to tackle this barbell need to have some growth and venture in our program more than we have historically, with the larger checks on the other end in order to deploy into the program requirements. But the oversight has been strengthened for both parts of that barbell.
And when you mention the oversight, you're talking about the three major committees that you...
Two in particular. The Total Fund Committee, Management Committee, which would discuss the risk and are we getting paid for the risk and the liquidity, et cetera. And then the Underwriting Committee itself, which is should we underwrite, should we deploy, should we invest in that particular manager or co-investment, et cetera. So we're kind of we're looking at them every opportunity through both the risk and investment lens.
Excellent. And as I think you mentioned earlier in the discussion, that you would share all those two plus the other one.
I chair all three of those committees. In particular, for me, I want to be held accountable for making sure that these needle-moving decisions, that if they're going through, that we as a team have decided together, and I'm on board for all of them, because I feel it's really important to set that example of being held accountable for those decisions. And so I need to stand by them as much as I'm asking my team to stand by them for those larger decisions.
And one more, just a procedural thing. You meet, as you mentioned earlier, I think you said you're going to meet weekly in these meetings, and okay, the OAC is scheduled for every other Monday, but we can call ad hoc meetings. The other two meetings are held weekly, and we reserve time on both calendars for overflow. So if the Underwriting Committee is really meaty one week, we can use time in the Total Fund Committee. And we have a really excellent, I've been really impressed with the team's commitment to making sure that agendas are created in advance, materials are being distributed, by noon on the Friday, so that we have time by the Tuesday to have completely gone through the materials. We're really rolling up our sleeves for these opportunities that are of a size or of a nature that that they're getting floated up to one of these committees. And that impresses me, because as you mentioned earlier, the time sensitivity to many of these deals, they come and go, and if we don't take advantage of them, then we lost our opportunity there.
Yeah, the team has shown tremendous commitment. They showed tremendous commitment doing the 10-year humble look back. They're showing the same tremendous commitment to doing these weekly reviews of these companies, and also learning. We all learn from each other every week when we sit in the room and we debate and go back and forth. And that's also a cultural thing that we're building together over time. I'm not going to sit suggest for a moment that the first few meetings, they're always going to be, well, am I supposed to ask questions or am I supposed to poke and prod? We're trying to create this very open, dynamic environment to really bring constructive feedback and questions so that we just make for better investments.
Yeah. Thank you. That's very good. Thank you very much.
You're welcome.
Okay, and next I thought I had Controller Yi, but I seem to have lost you, so if you'd hit your button again, I can. Operator error on my part, I'm sure. There we go.
Okay. Thank you, Chairman Miller, and thank you, Nicole and the team. I really appreciate this presentation, given the overview that you gave us prior to this. And again, the focus on governance couldn't be more important. And it's not just governance. I actually see really some efficiencies that will be realized as well. And I hope for the team in the investment office, it's not, and I just want to say, I hope there is nothing that comes across as being critical in any of our conversations or deliberations. Because in so many ways, you've had to do your respective work almost in a silo. And to be able to centralize just a lot of the internal thinking and the ultimate decision. I like this concept of the investment underwriting committee especially, where there is the central point that everything can come to. So I just wanted to kind of uplift that because this is tough work. It's just tough, and to not be able to do it and to share just what you're discovering in your respective areas. You're doing it in an environment that continues to be highly competitive, and so to be able to give you this flexibility with still the checks and balances, I think is exactly kind of the right thing where we should be encouraging to really undergird the path forward as we continue to look at what those elements of that will be. I did have a couple questions. So in that vein, I'm comfortable with those staff delegation limits that are proposed. So, but on the PPO issue, and it may have been just my oversight looking at the various attachments, but is it fair to say or accurate to say that PPOs will be required for each of the areas? I got confused in terms of whether they would be required for the opportunistic strategies. And I appreciated the conversation around how PPO sometimes, particularly the costs and the timeliness of them, can eat into just any benefit that we would be realizing at the end of it. But could you just clarify whether they would be required for the opportunistic strategy? Yeah.
The opportunistic policy has never had any prudent person opinion requirements.
Okay. That's why I got confused. Okay. Yeah. Got it. And is there a reason why? Is it the scale, or is it kind of just the nature of kind of what those particular strategies are?
I think it's a combination of both scale and nature. I mean, I wasn't here for it, but when it was described to me in the way that I think of our opportunistic bucket, it is for those opportunities that do not fit neatly within any one silo. So it's difficult to, if there isn't a home for it to reside neatly, it's difficult to see necessarily the need or the value of bringing in, PPO that will only have a couple weeks time to execute on that oversight. So we just haven't worked that in because sometimes they move quickly. It's not a set timeline. Right. Sometimes they're really large in scale, et cetera. And so it just wasn't contemplated historically. And I am a strong believer that giving us as much flexibility as we can have within that opportunistic bucket is what that bucket was intended for.
Mm-hmm. Okay, that makes sense. And then,
sorry.
Oh, yeah, please. Yes.
From Wilshire. The opportunistic program up until now had a significant amount of focus on private debt, which was now created to be obviously a dedicated allocation in terms of private debt allocation. The PPO requirement is now formalized in the private debt program to be consistent with real assets program. So you will have the PPO requirement in the private debt. Opportunistic obviously is not a static allocation anymore, so that doesn't have the requirement that it never did for the PPO requirement.
I see. Okay, thank you for the clarification. Okay, thank you. My next question has to do, let's see, just kind of this whole concept of the dilution of CalPERS ownership stake in customized investment accounts. I just want to kind of get a sense of like what kinds of issues that would pose, from a governance perspective or maybe ESG framework. But can you talk about that a little bit?
I might have Greg come up in specific. Oh, I didn't see you at the end there, Greg. Sorry, go ahead.
Sure. Controller, I just want to clarify the question.
Yeah.
It's about the change in our percentage ownership in customized investment accounts.
Right.
Yeah. So currently, it's 100%.
Right.
The thinking there is there may be opportunities where we want to partner with another institution in taking on a customized investment account or in working with a partner. And right now, we're restricted from doing that because we would have to be 100% owner. So it kind of opens up a set of possibilities where we may be able to access high-quality managers where there's another high-quality allocator next to us and jointly invest. So that's the thinking around that shift.
Yeah, and I like the flexibility that affords. I think my question really relates to what happens when we are not 100% owner, and with respect to issues like ESG or governance.
Yeah, I think what you'd see is we would still have a very high level of influence in those situations, much more than we would have when making fund investments, where we tend to be a very small percentage. So I think you would still see us in a very advantaged position relative to funds, although we would have some trade-off around our absolute level of control, being 100% versus something less than that to pick up opportunities that might be really attractive. Now, it would be in our control to determine which of these we wanted to go into. And so I think we certainly have, we've been working to embed sustainability in kind of how we approach everything, so we have the option of doing it or not doing it up front. And I think you would find the level of governance still extremely high relative to kind of any other part of the program.
Yeah, and I would suspect just the conversation we had earlier about sustainable investing, that would be a consideration at the front end relative to
Correct.
That. Okay.
Yeah.
Okay, good. And then I'm trying to reconcile this issue. So I think about 6 years ago, CalPERS reduced the number of GPs to 25 or so, and lately has been increasing the number to broaden the pool of potential investors. And so would allowing up to 15% of committed capital to any GP restrict the pool and limit the diversification again?
Yes, so the way we think about it now is we want to have diversification across investment strategies. Managers are kind of one way of thinking of that, but it's an incomplete way of thinking about it. So historically, we've been very concentrated in large buyout. And what you've seen over the past number of years is us expanding our exposure to the middle market and growth and venture. And we think that gives us kind of what I think of as real diversification. Those segments may move differently than large buyout. So that's the overall kind of direction of travel. The thinking around increasing that percentage, while overall you are seeing we are having more managers, not fewer, over the past few years. The thought around doing that is there are times when we are offered co-investments that are large and we're looking to increase that part of our portfolio. That could lead to particular situations where you might have more exposure to a particular manager. We think of that as a positive dynamic because the co-investments are so fee advantaged relative to everything else that we wouldn't want to limit our ability to take on co-investment with high conviction managers. Now, I think that is one that would be I don't think that would come up with much frequency, but we wanted to use this opportunity to lay it out because to not take co-investment alongside our highest conviction managers, to me, would not be the direction we're working to move the program.
Right. Okay. Now that's helpful to think about diversification beyond just kind of the manager perspective. And then I think my last question is to you, Sarah, and that is. as the infrastructure portfolio becomes more international, and I think what I'm asking here is just as you're coming back to report to us about that, obviously I think that comes with a lot, probably more risk and different types of risk, and so just kind of your perspective on that.
To be clear, the international is developed international that we're asking for an increase to of 10%. But we come back annually and give our diversification, and it's also in Makita's semi-annual updates what the diversification is.
Okay. Okay. I'm every time we talk about going international, it just makes me nervous. So, because of just the global risks that are just attendant to anything we do around the globe.
It would be largely European exposure.
Okay. Appreciate that. Thank you. Thank you, Chairman Miller.
Okay, thank you. We've been at it quite a while, and I've got quite a list of folks with questions. So I think if we could take a 15-minute break, and then we'll reconvene and come back with Director Middleton's question at that point. Okay, let's reconvene. Let's call the investment committee back to order. And the next person I have is Director Middleton. Let's see if we can get you. I got.
Calling it to order because we're not. People are still talking.
Okay. No, everyone has stopped talking because I'm whispering now. Okay, Lisa, you have the floor. Oh, okay, just hit your button again. There you go.
Okay, thank you. I think Controller Lee hit on the first question that I wanted to ask, but let me do a little follow-up. As we go back to the meeting that we had in July off-site, clearly geopolitical risk was highlighted. One only has to open the newspaper to see how big of an issue it is. That does give some pause when we start to think about increasing the amount of infrastructure exposure we have on a global basis. So, reaction?
I'll have Sarah give a bit more of the detail, I guess, into the go-forward strategy. But I think big picture, I've been pushing our team really hard to make sure that we think through a global lens because we are a massive program and we have a lot of work to do to hit our objectives. And so we're going to be thoughtful and measured, but I think it behooves us to do the work to come to conclusions that are, a combination of experience, a combination of where our views are going forward, not taking kind of the current emotion around, but really thinking through a long-term patient investing lens. And so for asset classes like infrastructure, we are going to need to look farther afield than just North America. I think where we'll spend a great deal of time is understanding the jurisdictions that we're talking about and the partners, probably more importantly, the partners that we're going to find ourselves aligning with. But we're going to do that work, and part of us having, again, this new governance committee is my hope. And yes, I took the comments earlier around us expanding our diversity of thought, diversity, around the table. My hope is that by having more diversity of thought and experience around the table, we'll start to make better educated decisions and make sure we're taking the right risk-adjusted decisions at the end of the day. But I wouldn't want to give this board the impression that we're not thinking through a global lens at all times, because we must. And so we'll be thoughtful, and we'll make sure that for each of the strategies, frankly, any of these strategies going forward, we want this to be a dialogue with the board and to get perspective, the last thing I want you to ever do is open up the paper and be surprised at a broad strategic move that we've made without, at least doing the educating and bringing everyone along for the whole experience.
I would just add to that the request that we're asking is for developed markets. There are further restrictions on emerging markets of 0 to 15%. And 0 to 5% on frontier markets. And we're also leaving at the real assets level, we're leaving it at the current restrictions. So we're essentially limiting the ability to do international real estate and giving up to get the ability to do international infrastructure.
Okay. I think that's helpful, but clearly, as we move forward, there's going to need to be a recognition of the geopolitical risks, and that needs to be fully a part of all of our assessment as we look at investments going forward. All of that said, I'm very pleased to hear that infrastructure is going to be something that we're looking to increase rather than see diminish. So, lastly, with really, this is more comment than a question. I frankly appreciate the need to perhaps limit some of the number of PPOs that we get in order to become more efficient. But the other side to that is those PPOs that we are looking at need to become much more consequential as we move forward. Thank you, Mr. Chair.
Okay, thank you. Next, Director Willett.
Thank you so much, Chair Miller, and I first want to say thank you so much for this thoughtful presentation. I'm actually really excited about innovation and changes we need to deliver for our beneficiaries. And I understand cultural change is very difficult, and matching practical steps is not easy, so I also applaud and support those efforts. That being said, we're accountable to 2 million members on these decisions. And I think it puts the board in a difficult position to explain to our members why we're going to give increased delegated authority at this time. It's our fiduciary duty to be prudent, to be careful in these decisions. So I am cautious about providing more authority or delegation until we see how some of these changes, and especially the cultural changes, kind of shake out. I think something that would help me would be just understanding. You stated that there's a lot of, we're seeing larger and more deals happening, and I'm wondering how many deals have we lost out on, for example, and not just quantity, but maybe volume. Where would we be if we had at various tiers, right? Instead of going from what we have now to what's proposed, what would be in between, and what that would mean in terms of timelines. Like I said, how many deals do we lose out on? How much return for our members do we lose out on? As I stated, I'm just a little cautious without there being maybe assurances or conditions on the increased delegation. Any thoughts I'd appreciate.
Thank you for the comments. Let us go back and just do a bit of digging. I think it's one of those things, we don't know what we don't know. Right now, we're not perceived in the market as being a first call for some of the larger transactions because of our current delegated authorities, or our inability to say when someone calls, can you stand up for this capital if once through your own internal processes, or does it require board approval, et cetera. So we'll have to do some theoretical work for you, but understand, you'd like to have a view into that. My hope is that this added governance model that we've put in place for ourselves helps a lot to build up that trust, just knowing that we have that additional oversight. I also hope that us continuing to demonstrate that we're going to bring you along for our thinking, the whys, not just the look back and say, this is what we did, hope you like it, that we're going to be bringing this board along more as we think through some of our strategies. I hope that today you leave knowing that I'm absolutely holding myself accountable, as well as the rest of the team, for decisions going forward. We've got these 9 business objectives that ultimately at the end of the year, we'll look at each other and say, are we a success or are we not? And each of us is going to own those together. Again, it's anecdotal, but hopefully it's starting to show you a bit of the culture that we're building. And I have to say, I don't think it's anything new. I think this culture's been percolating for some time. I think that without having a CIO in place for a period of time, the team was waiting to have, because if that wasn't the case, then I would not have had the buy-in that I've had so quickly out of the gate for all of these new approaches. As was pointed out, when you've been able to operate for a number of years in a silo and suddenly somebody says, hey, despite what you're so-called allowed to do, I need to be discussing this stuff with you on a frequent basis, the natural reaction for many, if they didn't believe in this cultural change, or if they didn't believe that this was the right direction, would have been to have pushback, and I've had nothing but support on the matter. So again, I hear where you're coming from. I think I'd go back to, we're really asking for kind of a practical math ask in order to execute on the strategic asset allocation that we're now fortunate to be able to execute on behalf of the beneficiaries. Without some of the movement in these numbers, we just frankly will be having different conversations with the board, which will be, we aren't able to deploy in the way we need to in order to hit those objectives because of the math or the practicalities. But we can certainly come back for the next read and make sure that you have a good understanding of the building blocks, or maybe said differently, in theory, the types of transactions in the marketplace that should be coming to us that we're maybe not getting a call on. So we'll get creative to come back to you with some of that. I don't know if Greg or Sarah, if you guys have any other anecdotes to add to that. But that's the best I can think of to do that exercise.
I guess some of the anecdotes I could add, almost all of the infrastructure investments have had to be approved by the CIO because they exceed my delegation. And that causes some delays. And there are a few transactions that even exceeded the CIO's delegation that we had to scale back on because of the capping out at $2 billion on the infrastructure side.
Well, that'd be good to see then.
Mm-hmm. Thank you so much.
Yeah, thank you. And we'll consider that committee direction to come back with some further illumination in that regard. Great, thank you. Next, we have President Taylor. There we go.
Thank you, Chair Miller. I forgot a couple of things. One was I want to ask the value add of, I already know the value add, you've said it several times, of our governance, these governance committees. I guess what I'm looking at also that I forgot to ask was, how do you feel about the limitation it may impose on deal timeframes?
Yeah, we're making sure, and part of putting these in place, the deal team should not feel, these are being run in parallel with the timeline that the deal team is already on. And so it's just adding on an extra set of eyeballs. It's no more information. Frankly, what comes forward to this committee in my mind is table stakes. It's more that we as a team get to decide together on these needle-moving opportunities. The work that's being done, the input from the consultants, the input along the way from the deal team is already happening. And if anything, by having a preview or an additional set of eyes within this committee, we're asking that team to go back and sharpen their pencils in a few areas, whether it's around, what's the bigger opportunity, what's the partner dynamic, what kind of governance will we get, are we weaving in sustainability to the extent that we should be in our thinking, et cetera. So this won't slow us down because it's being run in parallel. It's just giving us more belts and suspenders on decision making.
So basically, as the deal starts, then they come to the committee with the new deal before
Correct.
It's really even come to fruition. It's not like a later thing.
No, it's not. I mean, the way that it works practically, Teresa, is if something falls within the realm of needs to come forward, there's a heads up memo, and that's really a discussion. Here's the opportunity, here's the partners, here's why we like it, here's why we think the resources should be, meaning people resources, why we should be spending time. Are there any objections? Are there anything we should be considering? And it's been amazing to see the dialogue because we have so many different perspectives around the table. Maybe James is bringing up a labor issue. Maybe, Sarah is bringing up a jurisdiction. Maybe Greg is saying, we have partners who are excellent in investing in that sector. We should be leaning into it. And so now the dialogue is suddenly becoming, really thorough, and it's arming that deal team with so much more, perhaps, than what they would just have in their own committees. And again, those committees continue. It's just this is an extra side piece that is happening alongside or in parallel.
I really like the communication. I think that's excellent. I love seeing more communication, not less, obviously. So I'm very pleased about that, and thank you for the explanation. I wanted to, I don't know how to say this without maybe making some folks mad, but does this cause us to maybe need more meetings for investments? Because it sounds like as deals are coming through, we're going to be needing to know this, or are we going to have emails?
I think, so there's a couple of things. The pipelines, we're cleaning up our pipeline review to make sure that they're thorough, and we're adding a few more columns, if you will. We're adding more information in those regular way pipelines that you already see. I think we tried on for size in the last board meeting when we do that round table, the round robin of each of the asset class heads, where historically we've discussed managers. The intent now of having some of that is in confidence, because these things will be confidential matters. It gives us a moment to say, hey, we're thinking about opportunity XYZ, stay tuned. I know that you have the opportunity to be in dialogue with Marcy on a frequent basis, and so I've committed to Marcy that she not ever be surprised by opportunities that we're looking at. And I mean, we have big ambitions to really grow our co-investment program, but at the end of the day, what limits us is just the hands and eyeballs and feet. So, I mean, we're very ambitious and we'll work towards it, but this will be a ramp up. It won't be kind of hurled at you all at once.
Okay.
And so we'll make sure that we use the tools that we currently have. We'll make sure we use that time we have with you during our quarterly meetings to flag for you any opportunities, and I'll make sure I use the communication channels I have with Marcy and you have with Marcy to keep you up to speed on things.
Okay, that would be awesome. And then my last thing, I think I'm going to jump on what Ms. Middleton and Ms. Yee said, which is infrastructure is a totally different deal than the real estate that we're, so I'm just making sure we don't do Russia. That's all. So, I gotcha. All right, thank you very much.
Thank you.
Okay, thank you. Next, we have a question from Director Pacheco. Let's try it again. There we go.
All right, very good. Thank you. Thank you, Nicole. So my question is it's actually back to Board Member Willett and also with Teresa regarding the alignment of the enhanced governance framework. And actually, with respect to the Total Fund Management Committee and the Investment Underwriting Committee and the reporting aspect, of going back to the board, like, we're providing you all these additional tools, hopefully, but I want to know how you would be reporting that information back to us so that we can, see we have some, high level or oversight on this new process. Can you elaborate on that?
Yes, certainly. So for the Total Fund Management Committee, the team has been working quite diligently on providing me with a CIO dashboard as we work on this together, the things that are pertinent and relevant and on my mind. And so the thought is once we work the kinks out and hopefully in the timing for November when we start to introduce some of these new concepts to the board, that'll end up being a regular tool that we'll share with you so that you're looking through my lens and you know what's on my mind, and we'll work on that together. And again, those are the types of opportunities we have to work on it together, because you might say, you know what, Nicole, I'd like a bit more of a deeper insight into how much of your pipeline is specifically into emerging markets and how, what does that flow look like and who are the trusted partners? I mean, there's part of our data and tech strategy is to make sure that we are using the bits of data to be better decision makers, but also to be able to share how we make those decisions with the board and with the rest of the executive team, frankly. So my hope is that we're thinking through that exact same lens that you are, whereas sharing with you how we think and how we make decisions only benefits all of us so that no one's surprised.
And do you think that gathering this data, would it be difficult, or do you foresee any roadblocks?
Most of the data exists. I think that we could invest in and need to invest in different tools to maybe integrate where the data is today. I think that there are certainly tools in the market that help us with more user-friendly reporting of that data that we have that exists and make us more efficient. And so we're right in the midst of thinking about our broader investment tech strategy. We have technology in lots of pockets. We've got world-class technology and technology leaders. It's just a matter of us pulling it together through the lens of the Invo team and saying, what have we got? What should we be leveraging? Where could we maybe be more efficient, both through a spend perspective, but also a return on effort perspective on where the data sits, how we use it, how we share it, and make decisions with it.
Oh, excellent. Thank you very much for that information.
Okay, thank you. And I don't see any more requests to speak from the board. We do have a request to speak from a member of the public who's in attendance on 5B, so I'll call Alyssa Giacchino up to the podium. And if you would introduce yourself for the record, and when you start speaking, your time will start and be displayed on the little clock there.
Good morning. Can you hear me? Good morning, Chair and committee members. Alyssa Giacchino with the nonprofit Private Equity Stakeholder Project. Echoing some of staff's remarks, the growth in private markets is transforming finance, but large players like private equity are hardly regulated and exempt from most financial disclosures, leaving regulators with more blind spots concerning the risks buyout firms might pose, Bloomberg recently reported. Private equity firms have invested over $1 trillion in the energy sector since 2010. The lion's share of these investments have been in conventional forms like oil, gas, and coal, and in many cases, dirty assets that public companies have offloaded. Private equity's lack of transparency obscures the hazards these investments pose to investors and the public, an important consideration as you look at scaling up. We're looking forward to hearing more from staff on how sustainability is integrated into these private market policy changes and the governance structure. Last week, we released a private equity climate risk scorecard, the first of its kind, that ranks 8 large private equity buyout firms based on metrics around their energy holdings and emissions, as well as their climate pledges. The scorecard was developed by the Private Equity Stakeholder Project and Americans for Financial Reform. The rankings include several private equity managers that CalPERS invests with. The Carlyle Group ranks last with an F grade due to its surpassingly dirty portfolio of fossil fuel holdings and weak climate policies. Following it are Warburg Pincus, KKR, Brookfield, and its subsidiary Oaktree, Ares, Apollo, Blackstone, and TPG. The billions of dollars that private equity firms have deployed to drill, frack, transport, store, refine fossil fuels, and generate energy stand in stark contrast to what climate scientists and international policymakers have called for to limit our trajectory to a 1.5 degrees Celsius warming scenario. With the scorecard, we've developed a set of demands for the private equity industry that seek to ensure alignment with science-based targets, disclosure of direct and indirect emissions, environmental impacts, energy transition plans, political spending and climate lobbying, and integration of climate and environmental justice with the communities impacted by the climate crisis. These demands were endorsed by 13 organizations, including the Action Center on Race and the Economy, Friends of the Earth, National Resources Defense Council, Public Citizen, and others. We encourage CalPERS to engage your private equity and infrastructure managers to ask them how they will ensure that their portfolios are aligned with science-based targets, that they transparently report energy holdings and all emissions, and work with impacted communities and workers on a just energy transition. Thank you so much.
Thank you for your comments.
And I have copies of the report to share. Thank you.
Okay, I have no more requests to speak, and so that will conclude this item. And we will move on to 5C, CalPERS Trust Level Review and Annual Program Reviews, with a great big thank you to the team for putting together and presenting the last item and all the informative discussion.
Thank you very much. We're just going to have a few of my colleagues come up and join me at the table here.
Wonderful.
We have Lauren Simiso, Arnie, Greg, and Sarah joining for this presentation. So this is our semi-annual trust level review with a deep dive of each of the individual program performance each September. And so I'm really pleased to be able to have myself with my colleagues up here today to dig into each of the programs. We'll have Lauren will first come up to describe and walk through some of the more macro issues ahead of us right now, and then we will get into each of the individual pieces of our program. The hope is by the end you'll have a very good understanding of what the role is and responsibility of each of the programs, how it's performed in this past year, some of the strategies or ideas that we're thinking about going forward, how we're weaving sustainability into those programs, and then again a frank look at what's worked and where we need to take the program. I'll do a quick high-level snapshot before handing it off to the rest of my team, and then towards the end we will leave time again for questions. So maybe without further ado, since we've had a great session in the previous two, I'll just pass it right over to Lauren to give us a high-level market overview.
Thank you. Lauren Rosborough-Watt from Economics. Thank you for having me here today. It's a pleasure. Thank you, Chairman Miller. What you'll see on the slides, there are more slides than I typically bring to the board. I'm not going to speak to everyone and skip through, but if you move to slide 5, that's where I'm going to spend the majority of my time, talking about the current stance of the global and US macro economy and the balance of risks going forward. And the following 4 slides for your interest are related to this discussion. So the current stance of the global macro environment can be characterized as one of slowing global momentum, and in some regions quite rapidly, and an increase in macroeconomic uncertainty. The US and global economies are slowing from their post-pandemic surge, which I'm sure you all know about. It continues to experience supply chain disruptions, although these are dissipating. The global labor market remains tight compared with both the pre-pandemic levels and also the post-global financial crisis, so post-2008 levels. And the world is experiencing more pronounced and explicit geopolitical tensions than what we've seen in a number of decades. So it's the culmination of these shocks that's resulted in the price pressure or the inflation that we see today. You know, US Personal Consumption Expenditures Index, so the Federal Reserve's preferred inflation measure, last printed 6.3% on the year. Headline inflation is higher than that. In the UK, headline inflation just recently slipped below 10% per annum, and in Europe, inflation is anticipated to breach 9% by the end of this quarter. And the consequence of that, in order to maintain price stability, central banks globally are now embarking on the fastest pace of policy tightening that we've seen since the late 1970s. Central banks have certainly expressed the need or the desire to bring aggregate demand closer to aggregate supply in order to dissipate these price pressures. What we know historically is that when central banks are committed to bringing price pressures back towards their target, that they have been successful in doing so. Relatedly, quantitative easing and quantitative tightening, so the cessation of quantitative easing, to be clear, and quantitative tightening, increases uncertainty. So together, macroeconomic volatility, greater household uncertainty and risk aversion has weighed on asset prices and asset returns. When we look forward from a cyclical or business cycle perspective, the balance of risks continues to be tilted towards tighter financial conditions going forward and weaker growth, in particular in the near term. Indeed, many analysts are anticipating recession in Europe by the end of this year, and some analysts are now expecting a recession in the US in early 2023. I want to take a step back briefly and talk just a little around the shocks that we've seen. Pandemic, supply chain, high inflation, conflict. These are things that the global economy has experienced in the past. But the combination of these shocks in such a tight time period is definitely unique. There are some similarities and some differences, but I think it's fair to say that the unusual and sizable nature of these shocks has impacted on financial market and asset price returns over the last year. I'm going to take an extra step back again and bifurcate a little bit from the short run to the long run. Part of our role is to consider how the macro economy and changes in the structure, whether that changes long-run relationships. And I brought a number of open questions to you around 18 months ago. At that point, it was just after the pandemic, saying here's a number of questions that we might want to think about and investigate about whether the structure of the economy has changed going forward. I'm just going to bring forward three at this point in time. One of them was monetary policy, and I think it's fair to say that quantitative easing now is a sort of a part of the standard toolkit that central banks use now going forward, and that has an impact on cross-correlations of assets and also on the asymmetry of downturns now that central banks can move beyond the zero lower bound of interest rates and continue to ease policy if necessary. Another question we presented was on inflation. And the salient point here is that high inflation and low growth is an unusual state of the world, although we have seen it before. And I think it's important to draw out that inflation, by definition, is a transitory state. It is a rate of change in prices over time. And when central banks are committed to ensure that inflation remains within their target, typically around that 2% level on an annual basis, that they can do so in the near term, but of course this is transitory. Once inflation pressures have dissipated, central banks will, take their proverbial foot off the brake and ease tightening policy going forward. And the final relationship is whether the drivers of long-run interest rates, and we've spoken about this with you before, 3 of them, population, demographics, globalization, whether these drivers of long-run interest rates have changed. The pandemic, I would say, has brought to the front of mind the impact of these delicately balanced supply chain linkages and relatedly deglobalization. And we have seen some evidence of onshoring globally. And we have seen also some discussion around conflict around globalization within some global economies. So these are always potential future states of the world that we consider. But in the near term, the probabilities around those have changed somewhat. Deglobalization in particular has permanent effects on both the US economy, but also the global economy and how it functions. So I think my 3 main talking points here today was to highlight to you where we've been over the past year, what in terms of the business cycle cyclical effects look like the balance of risks going forward. The second one was to highlight once again the unusual nature of the shocks and the combination of the shocks that we've seen in the last 2 years, but also over the last year. And the final one was to highlight to you how we think around some of these impacts and whether that has permanent effects on the economy and what that means for both the global economy but also for our portfolio going forward. Thank you for your time today.
Thank you, Lauren. So from here, if we could move the page forward, please. To page, do you have a clicker? Just to the table of contents. There we go, for test level highlights. So as we said, today I will give a brief overview, some of which we've touched on already, and then we'll dive right into each of the program reviews and then come back with some questions. If you could turn to the next page, please. So we saw a brief version of this earlier today. As we know, that the PERF ended the year down negative 6.1%, which was the first negative fiscal year return since fiscal year 09. And as mentioned, the market value was down almost $30 billion from June 30th, 21st, and down $62 billion approximately from its height around the end of calendar year 2021. Including that negative 1-year return, however, the 10-year PERF return of 7.7% does exceed the actuarial discount rates in effect for most of the period, but that discount rate was lowered recently from 7.75% to 6.8% over the 10-year period. Next slide, please. And so as we touched on earlier, this cone chart shows that the PERF's cumulative total return from July of 2018 to June of 22 relative to the return and volatility expectations under the strategic asset allocation have been well within those expectations. We have experienced less risk than experienced, and we've also earned lower returns than expected. Again, we saw this chart briefly in the last presentation. Next slide, please. When we dive into the asset classes themselves, and we'll get into this in each of the programs more deeply, you'll see that the private assets, private equity and real assets have been amongst the highest performing asset classes for all periods. Private equity has been the highest performing asset class across all longer term periods, i.e. the 3, 5, and 10 year. Really, the 1-year return of negative 6.1% was driven by the negative performance of our public asset programs, i.e. the public equity and income programs, which was only partially offset by the large positive returns of the private assets programs. Growth assets, again, that would be considering both public equity and private equity, were the primary drivers of the 5-year return. The 2 growth asset classes contributed 80% of our positive 6.7 5-year return, but only account for just under 60% or 58% of our asset allocation. And all programs have made positive contributions to the 5-year returns. Next page, please. In summary, when we look at the total fund excess return by asset class versus the benchmark, we do see that the PERF has a positive excess return for all the periods of 10-year, 5-year, 3-year, and 1 year, with private equity again experiencing the largest excess returns over most periods, with the most recent 1-year outperformance of 1,297 basis points. And again, this has really been the driver of PERF's excess returns in most recent periods, whereas real assets have had negative excess returns across these periods. Next page, please. So the total fund risk summary, as we said, we're going to start using, going forward in November, we'll start using the board meeting to dig a lot deeper into our risk profile. The total fund tracking error is 1.63%, while the actionable tracking error, which I believe is a metric that got introduced just a couple years ago, capturing all our public market strategies and our allocation management, is just at 0.1%. I mean, the message here that we discussed earlier is that we have very low actionable tracking error, very low active risk being taken in the portfolio. The beta of 1.1 reflects a higher risk posture of the total fund versus our policy benchmark, which again is also validated by the higher portfolio volatility of the 12.9% that you see versus the benchmark volatility of 11.7. We saw and we've discussed that the fund has an underexposure to U.S. assets versus its benchmark. And the highest contributor to our actionable tracking error has in fact come from our credit-related spread factors versus any other area. Next page, please. When we think about risk, it should be no surprise that our total fund volatility is really dominated by from our growth-sensitive asset classes, such as our cap-weighted program, which is about just over 40% contribution to the risk, our factor-weighted program at 15%, and then private equity at 25.3% contribution to our fund volatility. The Treasury segment acts as a volatility diversifier, so it has a negative contribution of 0.4% to the total volatility. And in terms of tracking error, as we had mentioned earlier, the majority is coming from private assets, with private equity almost at 80% of that tracking error, and real assets just at 18.5%. The final page that I'll touch on briefly is just overseeing our investment expenses. On the next page, please. This is just to summarize our internal versus external investments and the cost of those programs, demonstrating the trend line, if you will, of the total external management fees, as well as our internal or investment admin costs. Our implementation style of having more internally managed funds has certainly shown to be an advantage when we're looking at our CEM benchmarking comparison peer group. But as we grow into that co-investment program and doing more deals with external managers, you can expect the trend line for external managers to continue to increase over time. But overall, our administrative and investment operating costs have remained relatively flat. Next slide, please. So today, where we hope we're able to have an open dialogue with the board is really to look at two buckets. Number one, what's worked, and number two, our areas for refinement. As you know, the ALM cycle completed the adoption of our new strategic asset allocation in November. We've added new asset classes such as private debt and emerging market sovereign debt. We've introduced leverage to improve portfolio diversification. We have some key hires in place, myself coming on board, and we're in market for a few other key hires to make sure that we're executing on the strategy. And so we do, and as we discussed earlier, we feel like in the market right now we are very well positioned to take advantage of market dynamics for finding real value and expanding our co-investment program, just to name a few. But as we've also discussed today, there are a number of areas for refinement, and there's a number of areas when we look back, we need to do more work. We need to make sure we have the resources in place, the right appropriate strategies, and we need to make sure we're constantly communicating with yourselves and our stakeholders on our intentions around that. And so while private equity and real asset allocations are near our long-term targets, we do need to continue to deploy into private assets consistently and in a disciplined manner based on our lessons learned. Our people strategy, I said it earlier, our assets go up and down the elevators each day, and so we have a real requirement and a real priority around making sure we're attracting, retaining, and equally important, just developing the talent that we have in place. We have, one of the people often ask, what were some of the pleasant surprises? One of the real surprises to the upside for me when I arrived here was just the breadth and depth of the bench strength that we have here. I think continually developing our skills and sharpening our pencils and learning as the market changes around us, making sure we're staying ahead of that is really important for our existing team in addition to bringing on additional talent. So we're very focused on that. And I need to make sure that we are incentivized to perform, that we are incentivized and to be held accountable. And so we're working through that. Part of that, as I said, is to take a much deeper dive on how we think about whether we are being paid for the risk we are taking, having a better system in place for monitoring our programs and holding ourselves accountable for that. So that really all falls underneath people strategy, and which is why it's one of our 9 core business objectives. I mentioned earlier in one of the questions about technology and innovation, we need to build this culture of innovation. We have a few programs in place, but I think exposing our team and bringing real thought leaders that are our current partners or thought leaders that are potential partners in the tent, so to speak, to help drive skill development within our team, to introduce new innovations, for us to be open-minded to hear out what other groups are doing. We've got a large group that's going to tour the Canadian pensions, for example, in a few weeks, where we're going to learn from our peers in Canada everything from what they're doing with technology, what they're doing with risk management, what they're doing in the investing world. Being open-minded to learn from others and to learn from each other, I think, is part of our cultural evolution here that we're really working hard towards. The improved governance model, we've spent some time on it, but just based on the questions, we'll do a better job at making sure you really understand what exactly it is that we're doing within those committees and why we think it's making us better decision makers. And so we'll take the opportunity to give you examples of opportunities that come in. We'll share with you our experience of, here was a heads up memo that caused us pause, and we said, no, thank you. Here's a heads up memo where we said we need to do more work and where we pivoted to partner with another partner. We'll bring you along for that journey when we have the opportunity to have some of those one-on-one times to make sure that you're very clear on why we think we've got a better mousetrap as far as decision making and governance. And so what I'd like to do next, page please, is really transition to each of the different programs. Again, having at a high level covered total fund, we're going to take time to review the individual programs. Each section has the following bits of information to be presented. We're going to talk about the role of the asset class, including the risk and return profile. We're going to talk about the market environment and investable themes that are pertinent to each of the asset classes. We'll talk about our asset allocation targets and the ranges. We'll review our key performance and risk measures that each of the asset class heads thinks about. We're going to highlight how ESG is integrated into our programs and give you some insights into what we've been up to this past year. And then we're continuing this journey of evaluating ourselves, really looking in the mirror, really, taking a look at what we've done, how can we do it, and talking about it and being humble about it. And so you'll hear our own self-evaluation by each program around what we think is working and really where we need to take ownership for refinement. And finally, we'll look at key areas of focus for each of the programs for this fiscal year. So without further ado, I'd like to call upon Samiso to introduce to us our Global Equities Program. Thanks, Samiso.
Thank you, Nicole. Good afternoon, members of the Investment Committee. Samiso Nzima, CalPERS staff. Today, I'm going to walk you through the Global Equity Annual Program Review. I won't go into each and every slide, but I'll seek to give you an overview of the performance, accomplishments, and forward-looking initiatives. Looking at slide 20, Really, I want to start talking about the role of public equity within the total fund, because as Nicole alluded to earlier, we really need to look at these not in a siloed approach, but what each program brings to the total fund. The role of public equity in the total fund is to provide growth exposure, efficiently capture the equity risk premium over a full market cycle, and be a source of liquidity. The program is essentially split into two. The cap-weighted segment, which is 67% of the program, and the factor-weighted segment, which is 33% of the program. I'll go through each of those segments as I go through the presentation. About 96% of the public equity program is invested in cost-efficient, internally managed strategies. If we could move to slide 21, please. This slide shows the board-approved CMAs. We invest in public equity for the higher expected returns relative to other asset classes, but the high returns come with high volatility. That is the variation around the mean. As shown on this slide, you can actually see the risk-return dynamics of the public asset class. With the cap-weighted segment, annualized expected return of 6.8% and the expected annualized volatility of 17%. In the factor-weighted segment, expected return of 5.1% and expected volatility of 13.5%. It is important to note, as Nicole discussed this earlier, that the factor-weighted segment has a lower volatility than the cap-weighted segment. It is still riskier or has higher volatility than most of the asset classes that we have, bar private equity. So it is still a growth asset class. It will still have higher volatility, even though it is lower than the cap-weighted segment. I make this point to emphasize the fact that the factor-weighted segment, while it is defensive, it is only defensive relative to the cap-weighted segment and not to the rest of the portfolio. If we can move on to slide 22, please. On this slide, I'll talk about the market environment and some of the investment themes that we're looking at. The high level of inflation in the economy has led the Federal Reserve to raise interest rates aggressively, and this has roiled equity markets. Fears that the Fed will over-tighten financial conditions and cause a recession, both an economic recession as well as an earnings recession, have resulted in the contraction of multiples as well as the downward revision of earnings expectations, and hence the current equity market drawdown that we are seeing. The risk-reward dynamic for equities in the short term looks challenged given the Fed's continued raising of interest rates, and thus we expect to continue to see a volatile equity market. As discussed during the June IC, equity markets go through periods of high volatility and severe market drawdowns, but tend to rise over the long term, reflecting economic growth. The tendency of equity markets to rise over the long term rewards those investors who can weather the short-term storm of volatility and market drawdowns. Currently, there is a lot of dispersion in terms of valuations in the equity market, and this is actually a stock picker's market. The market is prime for active management. Here we're talking about, looking at companies which have growth at reasonable price, free cash flows, quality growth, companies with greater pricing power, and so forth. We must be responsive to the current market environment and be nimble. Public market valuations have rapidly adjusted downwards, creating good entry points. History suggests that periods of market volatility and indiscriminate selling of stocks presents a richer alpha opportunity set for active strategies, and hence our goal is to increase our allocation to active equity strategies. If we could turn on to slide 24, please. Now I'm going to spend a little bit more time on the cap-weighted segment of the public equity portfolio. This segment is largely indexed, with 94% allocation to the index-oriented strategies. This was a result of the 2019 strategic decision to reduce active risk in the portfolio. For the last fiscal year, the cap-weighted segment earned a negative 15.8% compared to its benchmark return of a negative 16%. Thus, we slightly outperformed the benchmark by 20 basis points, but it's still a negative return. Over the longer period, the 3, 5, and 10-year periods, the cap-weighted segment had positive absolute returns as well as positive excess returns. On a cumulative basis relative to the 2017 SAA expectations, the cap-weighted segment performed in line with those expectations. I will not go through slides 25 through 27, but these slides show the breakdown of the performance and risk of the cap-weighted segment. Nonetheless, all the underlying strategies in the cap-weighted segment had positive excess returns over the 1, 3, 5, and 10-year periods, with the only exception being the Emerging Manager Program. If we could move to slide 28, please. Let's see, I think should be slide. Let's look at the next slide, 29. Okay, thank you. So here now we're looking at the factor-weighted segment. For the last fiscal year, the factor-weighted segment earned a negative return of 6.9% compared to its benchmark return of a negative 6.8%. As you may recall, and as we discussed earlier, the factor-weighted segment is defensive in nature. It tends to underperform the equity market when equity markets are going up, and tends to outperform equity markets when equity markets are falling. The goal of the factor-weighted portfolio is really to dampen the volatility. So if you look at the volatility of the cap-weighted segment, that volatility is 18.5%. That's the forecasted volatility, whereas the factor-weighted segment is an forecasted volatility of 13.7%. From a performance perspective, we can actually see this attribute when you compare the performance of the two segments. With the cap-weighted segment and the negative 15.8% this past fiscal year, the factor-weighted segment and a negative 6.9%. So it actually did the job that we expected it to do in terms of having a relatively better performance than the cap-weighted segment. If we could move to slide 33, please. So now I'll shift gears and talk about our work on the governance and sustainability strategy. We continue to execute on our governance and sustainability strategy, which focuses on improving long-term sustainability and resilience of the portfolio. We do this by holding boards of our portfolio companies accountable on executive compensation, which is pay for performance, corporate board diversity, and climate change. On executive compensation, we continue to vote against executive pay plans which do not show sufficient alignment between pay and performance. We also vote against compensation committee members for designing pay plans that do not align pay and performance. On corporate board diversity, we continue to see an increase in the number of diverse directors appointed to boards. We vote against nominating and governance committee members where we don't see improvements in terms of board diversity. On climate change, we voted against 95 directors at 26 Climate Action 100 Plus companies for not adequately responding to the Climate Action 100 initiatives. Slides 33 through 37 provides additional detail regarding the work that we're doing in terms of leading the market on sustainability issues. We consider sustainability an integral part of managing our public equity as well as our total portfolio for long-term resilience. If we could jump to slide 38, please. Now, in terms of evaluating what has worked and areas of refinement, as alluded to earlier, all the underlying strategies in the cap-weighted segment and positive excess return over the 1, 3, 5, and 10-year periods, with the exception of the Emerging Manager Program. Applying the lessons that we've learned from history can only enhance our ability to add value to the CalPERS portfolio. Additionally, we continue to optimize our technology and operating costs, resulting in cost savings in the program. In terms of areas of refinement, as Nicole alluded to, one of the things that we're looking at is the enhancement of the active risk allocation framework to facilitate an increased allocation to active strategies to take advantage of increased market volatility and further diversify the active equity strategies. We're also working to refine the business process around active strategic searches and contracting to facilitate the opportunistic deployment of capital. If you move to slide 39, please. So in terms of the priorities, the initiatives that we're looking at on a going forward basis, we'll continue to execute on the board-approved governance and sustainability strategy and to influence the broader market when it comes to sustainability issues. We will work to thoughtfully build back our active equity strategies book, ensuring that it fits within the total fund mandate to efficiently harvest the equity risk premium. Earlier on, Nicole did refer to the fact that we cut active risk or allocation to active risk in 2019, and that has never been deployed back. So this is part of that effort in terms of deploying back some of that active risk. We're actively engaging with some of our strategic partners to explore strategies which may help mitigate the growth orientation of the portfolio in the short term. We're looking at both defensive and value strategies. We'll also look at different regions, sectors, and factors to see if there are areas that can better weather the high inflation and rising interest rate environment. That is all I had for you today. Thank you for the opportunity to share our team views. And I think I'll hand it back to Nicole.
Yes, thank you, Sumisa. We thought we'd try to keep this interactive unless you disagree and pause between each of the presentations so that as your questions are coming up by each of the programs, you can ask them, or is your preference to go through each of them and then save for the end? Whatever works best for you.
I have no requests for questions right at the moment. Oh, there I do. So
Sure, great.
There's Controller
There's
E.
just a lot, so we figured maybe we'd open it for questions in between each of the presentations.
There we go. Oh, okay. Let's get Controller E, then Director Pacheco.
Great. Thank you very much. I really like the structure of the presentation, so thank you for the thoughtfulness there. My first question actually goes back to one of the slides, Nicole, that you had addressed, slide 17, and it had to do with the increase in investment fees. I just wanted to understand a little bit better. So we have the fees increasing to 21, just a little over 21 basis points this year from 15.4 basis points last year. And just why the increase, since there was less AUM and the performance was much lower than the prior year?
I'll get Greg to give you more of the specific details if needed after my comment, but essentially these aren't going to show up linearly. Often fees are called upon or are paid as capital is being called, and we would have been in a very heavy deployment in the last 3 years. You would have seen we've been deploying capital into those private markets, and so given how busy the markets have been, the opportunity sets that we've had, our managers most likely, what this is reflecting is that capital is being called and has been deployed, and therefore the fees are starting to get charged. Now that's not always the case. Sometimes fees are paid on committed dollars, but other times they're paid on invested dollars. And so what I would say to you is what you should read from this is that we're very active in deploying capital into private markets, which is what we're trying to do because of the sins of past, if you will. And that number will be volatile, and it will reflect our activity with third-party managers, which we need because of the size of the pool we're trying to deploy, in addition to if and when we build up our own expertise in-house, we will need to leverage the expertise of third-party partners, where we'll get more bang for our buck, if you will, is if we do a good job at choosing the right partners and finding ways to do more with them in more cost-efficient manner, like co-investing, which is what Greg and Sarah are spending a bunch of their time thinking through when we choose partners.
Sure.
What's the purpose of the partner? Do we see a path to doing more cost-efficient deployment of capital, et cetera?
Okay.
I don't know if Greg or Sarah, if you guys had additional comments on that, but that's how I would read that chart.
Yeah, I would just jump in with a couple of things really quickly, Madam Controller. Number one, the dashed line is the internal management or internal expenses, and then the solid line is external. So it's actually the total of those two that is the total expense load for the organization. So the total would get you to about 25 basis points, which is actually really cost advantaged relative to really all of our peers. The other thing is, again, and this is to Nicole's point, orders of magnitude at the end of fiscal year 21, we had something like 6% private equity, something like 10% real assets, and something like 0 private debt. And we know those are the more expensive asset classes. Fast forward a year, and part of it does have to do with the denominator, but part of it also just has to do with really strong deployment that you saw talked about in the sort of performance review. You get to the end of this fiscal year, and we're approaching 13% private equity, up to 13% real assets, and about 1.5% of private debt, and those are just the more expensive asset classes. So, Greg talks about this a lot. We all talk about this a lot. You really want to think of net performance, net of expenses.
Right.
But we would expect to see the costs go up for the foreseeable future, not the way that they were pre-financial crisis, but I would expect to see the costs go up in a handful of basis points as we continue to get traction in the private assets.
No, I appreciate that, and I'm not looking for any more granular. It was just kind of from our perspective looking at the increase, just kind of what's the framework within which we need to consider whether we should be concerned or not. Yeah.
Yeah, you can see the focus that we put on fees and the like, and this continues to be a focus. And it's one of the reasons why I really like this chart, is because it helps us see where they're coming from, and then also see what is AUM based and what is capital deployment based.
Yeah.
But this is definitely private assets.
Okay, I appreciate that. And I don't know, Greg or Sarah, if you wanted to add anything else, but I'm not meant to be.
I just had a quick point on private equity, and I think Nicole and Dan laid it out well, but within private equity, what we're seeing, there's an important distinction, just the absolute fees being paid, and then the fees as a % of our assets under management. What we've seen now for a couple years, which is continuing this year, is the absolute fees have gone up because we're deploying much more capital, but the fees as a % of our AUM in private equity continue to decline as a result of the increased scale we have in co-investment. So that really is exactly what we're looking to drive. And I would expect that to continue to happen going forward. But then we have these other areas within private markets that both Nicole and Dan hit on, where we're deploying that are adding to the overall fee load of the entire fund.
Got it. Okay.
The only thing that I'll add is that management fees as a % of assets under management were flat over the year, but because of the outsized performance in real estate of 24%, a lot of the partners hit their incentive payouts. And so our incentive payouts were higher than they were in 2021.
Got it. Great, very helpful. Thank you. And then two other questions, and Samisa, I'm going to pose these to you on slide 33. So just curious about why CalPERS voted against fewer executive comp proposals and compensation committee directors this year compared to last.
Yeah, so if you recall, in 2021, we reduced, so we narrowed our benchmark, so that kind of reduced the number of companies that we have in the benchmark from about 12,000 companies to about 6,000 companies.
Yeah.
So really we're voting on a fewer we're voting on a fewer say on pay proposals because of that. And from a percentage perspective, we're looking at, the 48% versus 54%. Ideally, you'd actually want to see that number come down, over the years, because then that means that pay is aligned with performance.
Right.
And hopefully that's part of what's happening there in terms of that. But also part of it could be that the smaller companies that we narrowed out of our benchmark maybe had sort of more challenged pay for performance alignment.
Sure.
So it could be a combination of those both things.
Okay, good. Well, hopefully it's an improvement in terms of the company's performance. Okay. And then the other question is, can you give a flavor perhaps on some of the 2023 share owner proposals that may be contemplated?
Yeah, I think the way we've approached owner proposals really is twofold. It's one is based on the themes that we're looking at. Climate action, or corporate board diversity. If we are not getting traction from an engagement perspective, the next stage of accountability that we look at. So if we don't get traction, we vote against directors, whether it's members of the nominating and governance committee, whether it's members of the risk committee for climate. But the next stage after that in terms of accountability is to file shareholder proposals. So really it's dependent again on the issue of are we getting traction or not, and if we're not getting traction on that, then we file those the shareholder proposals. The other aspect really is related both in terms of the work we are doing, but also our partners, because sometimes we file proposals with partners. Some partners don't have the ability or they don't have the infrastructure to be able to file proposals like we do. So where we co-file with others and then run proxy solicitations. If you may recall, a few years ago, I think 3 or 4 years ago, we internalized the running of proxy solicitations to reduce the cost. And so we're actually able to run proxy solicitations internally and more effectively and cost efficiently. And so we use that path as well, where with trusted partners on issues that we care about, whether it's human capital management or things like that, where we can co-file proposals with trusted partners with the understanding that we'll run proxy solicitations.
Okay. So
I think we'll come back to the board, I think in March, where we preview the 2023 season in terms of these are the things that we are looking at and so forth. And I think that we'll come back to the board in March.
Okay. Yeah. No, I appreciate that. And I may have misread it as thinking that it was new areas versus those areas in which we have been actually leaders in engagement. So look forward to the report going forward. Thank you very much. Thank you, Mr. Chairman.
Okay, thank you. Next, we have Director Pacheco.
Yes, thank you very much, Chairman Miller. So my question is actually on page 26. It's on the cap-weighted excess returns by strategy. And it's basically about the public equities and the emerging manager program. It appears to be consistently a distractor of performance. And I'm just wondering what recommendations you may have on, achieving better outcomes in that portfolio.
Yeah, I think, when it comes to the Emerging Manager Program, I think we need as a team, not just the public equity side, but the total fund, really to take another look in terms of how the program is structured and whether we have the right partners in place, or what is it that is causing the underperformance. This is something which my team, at least in public equity, is something which we want to dig deeper into, but I also think it's much broader than just the public equity side of things. This is something which I know Nicole is in the process of hiring an MID for sustainable investments, and this falls under that role as well. So I'll defer to Nicole and see if she has any additional thoughts.
Yeah, I would just say I think this is a good example of, without a total fund lens on these programs, these things can start to run wild on their own. Exactly. And so the first question is if we are going to do emerging manager program, where are we getting the best risk-adjusted return? Where do we have the right skill set in choosing those managers? Where do we feel we're able to most move the needle? And all of those bits of the conversations need to go into the decision making versus just assuming that there should be an emerging manager program residing within the active program of Samiso's overall strategy. I mean, maybe there are better places for him to be thinking about taking active risk, and that emerging manager program could reside elsewhere. And so I think historically those types of decisions were done in a more siloed manner, and we're going to look at that through a different approach, through a total fund lens.
Total fund lens. Thank you. And then the other question I have is on the page 35 and 36 on the CalPERS board diversity engagement. So I noticed in the cohort, we had a lot of activity. We had a larger target, and then over time, from 2017 to 2020, it seemed to be, it seemed to have decreased. Is there a reason behind this, or I'm just trying to understand these graphs more clearly?
Thank you. Thank you for the question, and it's a good observation. Over time, you actually want to see that this graph decrease, because what it says to you is that we have fewer companies that lack diversity on their boards. So if you recall, we started this engagement or initiative in 2017, and at that point, there were 504 companies in the Russell 3000 based on our criteria that lacked board diversity. And so, each year, if you get more companies added to the index, then we run the screen again to see if, those companies lack diversity. So the decrease is actually a good thing, because it tells you that things are working. And this is supported, again, if you look at the targets relative to the companies that have actually added diversity after our engagements. You look at, the 2017 cohort, 90% of the surviving companies have added elements of diversity that they didn't have when we started engaging them. And, even the other cohorts, 2018, 2019, and 2020, you can see the numbers are really high. It means companies are getting our message and adding diversity to their boards. And that is why you don't see any cohort for 2021, because when we looked at those, the companies that we have that haven't added diversity, they're still the same companies that in the older cohort. There are no new companies that don't lack diversity that have come to the portfolio.
And when you're talking about diversity, you're talking about just adding, in what respect? Is it more gender, more minority, ethnic,
Yeah, so, technically, when we started this initiative, what we used, because of the lack of data, our criteria was to use gender as the identifier. But when we actually engage with companies, we engage them across all the spectrums of diversity, gender, race, sexual orientation, and so forth. So we're actually broader in the engagement. As the data improves, I think we'll be able to become more granular in terms of that. And we've been voting against boards where we feel they lack diversity, whether from an engagement perspective, even just from an numbers perspective, looking at their board composition and feeling like they don't have a reasonable level of diversity on the board.
That's wonderful. And just a side bit with respect to the of the companies that we have engaged with diversity and so forth, the information is being shared publicly, or is it just, I'm just trying to understand that whole process.
We don't. So our engagements with companies are private and confidential. So we engage privately. The only part that would be public would be when we vote against directors for lack of diversity. Then we would put that publicly in our voting portal, or when we run a proxy solicitation. We have filed a proxy proposal and we're running a proxy solicitation, then that becomes public. But in terms of the actual engagement, we feel, and history shows us that when we engage privately and confidentially, we tend to have results better than if we just go and name and shame in public.
Absolutely. Well, thank you very much. That was very good. Thank you very much.
Thank you. And next we have President Taylor.
Thank you. Thank you, Chair Miller. I was going to ask a bunch of those questions, so never mind. But I did want to ask Greg, and he already sat back, but I did want to ask Greg what he thought about our ESG integration in the private equity, and do we have an answer for the S? We have, I don't know, we have a lot of problems with the S in private equity, workforce issues, et cetera. Is there anything that, I know you guys are working on and integrating it, is there anything you can expand on?
Sure. We have been working to integrate ESG into private equity, I think, in a much more fulsome way. And the way we've approached it, and I can share some more detail later, but we really have wanted to understand the state of play today. So there is a tremendous amount happening in the private equity industry where managers are embedding ESG factors more deeply into their investing. But as an allocator, we have not been able to see that with the level of clarity we'd like across our portfolios. So our approach has really been to better understand the data. And that's where we have worked to bring together a group in the ESG Data Convergence Initiative to really track ESG data in a standardized and longitudinal way so that we can actually just see what's happening along these various factors. Our view is once we kind of have that real insight, then you can understand, and we would expect the levers to move.
Okay, great. I appreciate that. And then, Samiso, I appreciate your report on our ESG and our proxy voting. And I know that this isn't going to be your role next year. So, and someone asked you, I think Controller Yee asked you what your 2023 outlook was. Who's going to be directing that next year?
Good question. And yes, you're right, that is not going to be my role. We are in the process of hiring someone to backfill that position. We are hoping that at the November IC, that individual will be here. We cannot at this point sort of be specific about that because they're still technically working for another organization. But we have identified an individual, and they should be here by the next investment committee in November.
Okay, great. And so I want to tell you how much I appreciate you having the two roles and doing as much as you've done on our proxy voting and the work that you've done. So I just wanted you to know that we really do appreciate the work that you've done while you were taking on your new role in global equities. So,
yeah, and Madam President, while Samiso will hire a day-to-day director, he's still accountable for it because it's still in global equity.
True.
I was going to say thank you for the kind words. We do have a great team, in global equity, whether it's the portfolio management, day-to-day implementation and management of the portfolio, the governance and sustainability stuff. I'm here to represent the work that the team has done. So really, it's about the team. But thank you for the recognition.
Thank you very much. Thank you.
Okay, it looks like I have another question from Controller Yee.
Thank you, Chair Miller. And Greg, you mentioned the ESG data convergence project, and I don't remember, but has CalPERS joined the ILPA Diversity Initiative?
Controller, so as I believe you're aware, I joined the ILPA board recently. We have not technically joined that initiative, but we actually are well underway with a strategy that we're kind of pioneering within our own portfolio.
Okay.
It is still being developed, but I expect we'll be able to share a good bit more within the next 6 months. And I think I'm really hopeful that we may be able to kind of target diversity in a way that is particularly impactful given our unique position as CalPERS within the private equity industry.
Okay. Yeah, I wasn't sure whether it would be helpful in terms of just emphasizing CalPERS' commitment to DE&I with our general partners, but and yes, thank you for serving on that board on top of a full plate. Thank you. Thank you, Mr. Chairman.
Continue.
Excellent. So thank you for that. Next up, we'll have Arnie, and he will walk us through both the fixed income program and also is standing in for Jean Sue, and we'll discuss private debt. So we'll do a similar approach. We will have Arnie go through fixed income, pause, and then go on with the private debt program so we can get questions in.
Excellent.
Good afternoon. Arnie Phillips, Global Fixed Income. As Nicole mentioned, I will cover both global fixed income and the opportunistic area. They actually fit together quite well with opportunistic and primarily the private debt area, largely being a diversified form of fixed income. So they're actually quite complementary, and one of the reasons we're striving to get a larger allocation to private debt over time. So slide 41, which you have up there, just highlights global fixed income is designed to be to provide long-term equity diversification and to provide a reliable source of income and liquidity. This chart does show where the various product types land on the continuum of diversification, liquidity, and income. And while we do still believe the long-term relationships apply, fixed income clearly has not provided the expected diversification since the onset of the Russia-Ukraine conflict. And actually, the majority of the interest rate moves occurred in about a 2-month period following the onset of that conflict. And interestingly, and not in a good way, it's really the first time in over 40 years where we've seen the entire U.S. Treasury index and the S&P 500 index both drop more than 10% in a year. And so, going back, I had data back to 1980, and this was the first instance where we saw those large moves in the same direction. Pretty strong correlations in the past, moving opposite directions. And it's kind of interesting because the entire U.S. Treasury curve has performed quite poorly. Even the 5-year U.S. Treasury, which is below our U.S. Treasury index, we start 7 years and out, has dropped nearly 10% this year in price, even with its relatively short interest rate exposure. With the aggressive Federal Reserve interest rate hikes, we've actually seen the front end of the interest rate curve move much higher than the longer portions of the curve. The 2-year Treasury yield is up nearly 3% in the last year, with 30-year Treasuries up a little over 1%. So this has led to broad underperformance across the entire U.S. Treasury interest rate curve, really regardless of the level of duration. Next slide, please. This slide shows the capital market assumptions that were used in the last ALM cycle, and also highlights what made the ALM process so challenging. The capital market assumptions for projected returns in fixed income are certainly much lower than they have been historically. And while our strategic portfolio is designed to have a long-term horizon, this year's fixed income returns have actually, certainly been quite negative and quite disappointing. Next slide, please. This slide just really shows how, and talks about how volatile the asset markets and, as Lauren mentioned, just the overall global economy has been. And it certainly has increased risk in all asset markets, including the fixed income markets. Trying to look forward, we do think those same factors will provide opportunities to tactically deploy assets when managed through an active risk governance model that Nicole has put in place. So we are opportunistic that we can hopefully turn this into a positive. Slides 44 through 55 provide a quantitative view of the global fixed income segments, and I'll highlight some of the pages. Slide 44 shows how global fixed income was structured last year. We had 3 distinct strategic asset allocation segments with over 95% of those assets invested in cost-efficient, internally managed strategies. The U.S. Treasury and high yield segments are designed to be relatively passive in nature, so you will see very little tracking error in the slides that come in the next few slides because these segments were largely designed to match the indices risk characteristics. Turning to slide 45, please. Our strategic asset allocation does include a long fixed income duration profile. Said another way, we have a lot of interest rate risk exposure. This is intentional in the strategic asset allocation and is designed to provide long-term drawdown protection against an equity market drop. That risk exposure clearly did not work this year and resulted in a 16% loss for the U.S. Treasury segment. Switching to page 48, please. This shows the spread segment, which is the one segment that we actively manage. It has also had very little tracking error this year because we were not constructive on the markets. We have been and continue to be cautious about all the factors that Lauren laid out that are impacting the global economy, and so we are positioned accordingly. The relatively large interest rate exposure in the spread segment, though, did, along with the spread widening, did result in a relatively large absolute return underperformance this year. On an excess return performance versus the index, the spread segment continues to have very strong long-term data. And I would be remiss if I didn't note on this slide, Nicole noted, a lot of our active risk has not been compensated in the past. This is one area that we do have very strong information ratio, showing we have been compensated for taking risk in the active markets and fixed income over time. And we do have some ideas that we're working with Wilshire and the governance committees on some ways we think we can enhance that going forward. Page 50, please. This just highlights what we've talked about already. Each of the individual sleeves of the spread segments have very solid long-term excess return performance versus the index. But we were relatively flat this year, given our defensive posture, which you can see on page 52, showing the spread segments volatility, tracking error, and active positionings all at very low levels. Slide 53, we transitioned to the high yield segment. It is passive in nature at the moment. So by design, we are largely matching the index risk characteristics. The high yield segment did have a challenging year given that most risk assets underperformed during the year, which led to spread widening in high yield markets. And while it does have a lower interest rate exposure profile than most of our fixed income exposures, as I noted earlier, the large interest rate moves in the shorter part of the interest rate curve did contribute to negative absolute returns in the high yield segment too. Slide 55, please. This just highlights the passive nature of the high yield segment with volatility, tracking error, and active positioning metrics all at very low levels also. Slide 56. This shows global fixed income's governance and sustainability efforts, which really are embedded in global fixed income's daily fundamental analysis work. Our credit teams are looking at every company we have, whether we want to be neutral weighting, overweight, underweight, and governance and sustainability, we do believe leads to performance. And so it is a factor that every one of our analysts considers on every one of our companies. Slide 56 does show some of the recent accomplishments in this area. We've incorporated some rating agency ESG scores into the process. We've purchased a decent amount of sustainability-linked bonds, and the credit team developed for use within all of fixed income an ESG questionnaire for all of our global fixed income external managers. Slide 57, please. So global fixed income continues to be a strong long-term excess return provider and has successfully transitioned to the one team, one fund focus. But there's always efficiencies that can be incorporated into any process, and we're certainly working to improve the operational effectiveness in the new strategic asset allocation segment, which now includes 5 segments as opposed to the 3 we had in the past year. So we're working with other parts of the investment office to make these efficiency improvements. Slide 58, please. For the current year, we're going to continue to strive to do what we've done, which is provide long-term excess return versus the indices. We stand ready to help Nicole utilize our fundamental analysis expertise to assist the other areas of the total fund. This is likely to fit into the private markets on opportunistic real assets, primarily probably the infrastructure side, and then any co-invest opportunities that Greg may have. And we're going to continue to search for ways to add innovative returns in the fixed income markets. As I noted earlier, we are working with Wilshire in 2 different areas to get some data and solidify a strategy that will then go through the governance structure to hopefully add some enhanced abilities to provide some long-term return. And then finally, and I think very importantly, we are cautiously optimistic that we're close to rebuilding some key staff losses. We did lose some folks in investment grade, our mortgage team and on our sovereign team. We're pretty far along in hiring some of those folks, and so I'm certainly much more optimistic than I was maybe 2 or 3 months ago when the folks left, and we've made a lot of progress in a short amount of time. So looking forward to getting the team back together. So maybe I'll stop there before I move on to the opportunistic side of things and take any questions.
I have Director Taylor. President Taylor.
It's okay. You can call me Teresa, too. Thanks, Arnie. I appreciate it. Good. The only thing that piqued my interest, there was a lot. There was the interest rates that, didn't pay us this time around. I get it. We're looking for better opportunities. I just wanted to ask, you developed an ESG questionnaire for external managers. So what is that?
So it would be better answered by my credit team, but in essence, we want to, similar to maybe what Greg's doing, of reaching out to our managers every year and just getting an update on what they're doing in the area, what changes they've done, and if there's anything in there that maybe we can learn from to help us do our internal job better. But it was really, the first time we've done it, we reached out to other parts of the organization that have been doing it for, a time being. There didn't seem to be a reason to rebuild the wheel if other folks are already doing it well. But we did add a little bit of our own fixed income metrics to it. But really, it's just to one, show the external managers that we are watching, to show that we care about it, but also to get that feedback loop to hopefully learn something to do what we do internally better.
So the data is what you're looking to gather, right?
Yeah, and that's a good point, because it seems like on a lot of these areas that the lack of standardized data makes comparisons challenging. And so, we can at least start with our managers, and then hopefully over time, as we look to, and some of the things we're working with Wilshire on will add additional managers to build that template to then get the information from them. We may learn something unique from them that then we'll add to it. I view it as a very dynamic template. It is designed to acquire data, but will change as needed.
I appreciate that. I think also leveraging the sustainability group would be helpful for the questions, for sure, because they're on the ground with whatever company that they're talking to from a stakeholder, right, with whatever concerns there are. So I think that would be a good idea as well. So thank you.
Okay, thank you. I don't see any more questions from anyone on the team. And so is that about a wrap for that?
Yep. So I'll move over to Jean's area. Let me get back to my notes here. So Jean gave me her talking points, and I'll go through them. If we get into very detailed questions, I have a couple folks from her team here that will be prepared to answer. So slide 60, please. So we're there. So this highlights the main roles of the Opportunistic Strategies Group, which is primarily made up of private debt and our Low Liquidity Enhanced Return, or LLER program, which in aggregate are designed to harvest an illiquidity premium, produce current income, and to invest opportunistically. So each sleeve has a similar but independent mandate. LLER is intended to harvest the illiquidity premium of investments that have a remote probability of principal loss. Opportunistic Strategies focuses on investments that are either perceived to be undervalued or outside the strategic asset allocation. Important to note that private debt was initially incubated under the Opportunistic Strategies until it was given a strategic asset allocation in the recent ALM work. Private debt does seek to generate attractive risk-adjusted returns driven by the liquidity premium and the complexity in originating, underwriting, and structuring of private loans. Private debt does complement the private equity program, since investments tend to be at the top of the capital structure and generate current income. But it also complements and diversifies our global fixed income assets, given private debt's largely floating rate interest exposure, which was a huge positive this year, as opposed to the longer duration interest rates exposure in our global fixed income. Private debt is also diversifying relative to global fixed income in that it is not designed to be a liquidity provider like most of fixed income, so it should be able to produce higher long-term returns. And those benefits, both to private equity and to global fixed income, are why it ended up as a 5% allocation in the strategic and why we desire to have more of it. So slide 61, please. So this chart illustrates the capital market assumptions for private debt, and private debt does have one of the most attractive risk-adjusted return profiles among the asset classes, and is one of the few asset classes that actually has an expected return above the required rate of return, and obviously looks completely different than the fixed income assets towards the bottom of that chart. So again, showing the attractiveness and why we would like more of it. Slide 62, please. So this chart shows the allocation as of June 30th. And for the LLER program, we were able to build the portfolio from about $7 billion to almost $12 billion in the last fiscal year, which is the reason it is now the dominant portion of the overall portfolio. In the past 2 years, Jean's team has been able to deploy about $6 billion of the private debt program, so it accounts for about 34% of the opportunistic strategies. And we're estimating it should be able to grow to about $13 billion by the end of this fiscal year. And then this slide just highlights the consistency and diligence it takes to deploy assets in the private market. It takes time to scale in these markets, but we do think it's worth the effort and the diversifying benefits we will get from it. Slide 63, please. So diving into the performance of the sleeves, starting with the top left in the LLER program, it continues to contribute to the total fund with an outperformance over its benchmark over 3, 5, and since inception. And all that is despite the challenging market environment over the past year. Gene's team does not believe there is any credit concern in the portfolio, and we do expect a positive contribution to excess return once the market stabilizes. Moving on to the opportunistic section, currently only has 2 public market dislocation funds. This sector has generated an outperformance of 7.4% over its benchmark. The team was able to activate these funds during the onset of the COVID pandemic, which enabled CalPERS to capture attractive opportunities during that market dislocation. And despite the challenging market environment during the latest fiscal year, the funds were still able to generate a 6.4% return. And then finally, looking at the performance of private debt, it has generated meaningful outperformance of 300 basis points over the 7% benchmark. Although the program is still relatively small, the performance over the last fiscal year through a turbulent market environment highlights what we think is the attractiveness of the asset class in our strategic asset allocation. Slide 64 highlights some of the concerns. Really in private debt, the concern is really around the underlying borrowers' earnings and their ability to service their loans, and considering the impacts of the rising interest rate environment and the ongoing inflation challenges that the markets are anticipating and dealing with right now. Private debt does expect to continue to get attractive opportunities to deploy as opportunities that historically may have gone to the public markets will fall into the private market side. So Gene's team is ready to take advantage of that. Slide 65. This deals with the governance and sustainability section of what Gene's been working on. Gene has engaged her external managers to see how they incorporate ESG into their investment decisions. And Gene wanted me to highlight 2 examples of things that they've seen that they are thankful for and really appreciate the managers doing. One of the managers has embedded a mechanism into their structure that will lower rates if they meet in certain ESG criteria. And another manager took the initiative to be Article 8 compliant, which requires them to demonstrate and act with good governance practices. So probably similar to what Greg's doing. It's maybe not quite as mainstream there, but Gene is working to make it more mainstream. Slide 66. As we alluded earlier, the private debt area has deployed $6 billion. They've made about $20 billion in commitments, and the LLER program has grown to about $12 billion. In terms of areas for further refinement, Gene recognizes they need additional resources to sustain the current deployment pace, and importantly, require a different set of talent to further capture the economic benefit through co-investment opportunities. And then finally, the team does realize they will need further technological assistance to improve the existing infrastructure to help better understand the exposure, performance, and risks that are in the private debt portfolio. Slide 67, please. So going forward, Gene's team is focused on 4 main areas. The first is putting together a budget and a resourcing plan to achieve the 5% strategic asset allocation, which will require a large amount of work on her team. The second is establishing a formal review process for existing investments and strategies to better understand their risks and opportunities. The third is deploying the technology enhancements that we talked about and improve the compliance monitoring. And then finally, they'll just continue to deploy capital to meet that 5% strategic asset allocation. And with that, Dan, Nicole, and I are ready to take questions, and if you get weedy, we'll bring up Jonathan and Ryan to answer those.
I'm not seeing any questions from the board, but I did have a kind of a comment, but for anyone, I'm really encouraged at seeing the way we've kind of incorporated and aligned ourselves in terms of ESG efforts throughout the organization, but I'm seeing this real movement toward actual integration of it all. And I'm just wondering, how are you taking that all on, and how are you going to kind of take those individual aligned efforts that were kind of here and there and bring them all together and kind of conform them to some sort of constancy and priority and coordination, so that we really get that consistent integration over time along with these cultural changes?
Yeah, thank you for the question. I think it starts off with what we chatted about early on. We're bringing this role, this head of sustainability, into the INVO office, me showing tone from the top that this is a huge priority for us. It's woven into our 9 business objectives. And so the profile of the individual, I'm putting a lot of value on the potential candidate for this role of MID of sustainability, for someone who's had that task of taking pockets of greatness across an organization and finding a way to integrate it all so that we too can do the same thing. And so in short order, we're in the final strokes of panel interviews. We've got some great candidates for this MID of sustainability, but one of the things I've asked each of the panelists to do is to spend time with these individuals to make sure that they've been in that hot seat before of getting buy-in and pulling together these different programs that often reside in pockets at different stages of their own evolution, and making sure that they've had that experience of pulling it together.
Will that work also be part of the committee structure in the review, or will there perhaps be a separate committee for oversight and, again, coordination of harmonization of all those efforts?
Yeah, there's 6 or 7 legs to the mandate in my mind for this MID of sustainability. Some of those bits of the mandate would find airtime at our administration committee meeting. Some of those bits would find time specifically in the risk management committee or the total fund portfolio management, and some would find time within the underwriting committee. So to answer your question, it's yes, it just depends on which part of the mandate, because it is multifaceted. And that's why the individual, finding the right candidate to oversee this program, it's a tricky one, because we really need someone who's been able to have that executive presence and that experience of pulling together programs that often reside, but also to have experience in the investing side, have the experience in the creating strategy side. And so, and the great news is we actually have a few candidates who do show, great experience in a number of those areas. And so for us now, it's just who's going to fit best culturally for CalPERS. And so we've made some great traction there, and I'm really excited about the potential candidate base for this.
Great, thank you.
You're welcome.
Well, thank you for the presentation. It's been very encouraging and enlightening. And at this point, I guess we'll move on. Well, I'm thinking in terms of timing, we're just about due, we've been at it again for about 2 hours. We're just about due for a break, and then we have lunch coming right up. So I think it may be wise for us to just take our break and then roll into lunch and convene for 5D at about 2:15.
Sorry, Mr. Chair, we do still have 2 more asset classes as part of 5C.
Yeah,
We've got the 2 private asset classes.
Yeah, let's see. Yeah, well, we'll continue and then maybe see what time we wrap and head to lunch. But we do need to take a break pretty soon. So. Yeah, we're almost at 2 hours. Yeah. Okay.
So we'll carry on then. Maybe what I'd ask then is the 2 private asset classes that we have coming up, you've had the pleasure of seeing a lot of over time. And so I'm sure the team won't mind, but I'm going to ask that they accelerate through. This way it leaves us almost
We don't need to curtail it because we've got the time. I'm just trying to be cognizant of when we take our breaks. So.
I'll just have them be thoughtful of which pages they land on and leave time for the presentation, or sorry, for the questions. Okay, we'll carry on then. Thank you.
Thank you.
Okay, good afternoon, and thank you for the opportunity to provide the annual program review of the private equity asset class. I'll start with an overview of the role of private equity in our portfolio. Then we'll move into a discussion of the market environment, asset class performance, and how we are embedding sustainability more deeply into our program. I'll conclude with a brief assessment of the program as well as a look forward to priorities for the coming year. So on slide 71, we touch on the core role of private equity in our portfolio, and that is to generate returns in excess of public equity through investing in private companies. The program is guided by our long-term priorities, which include forming deep partnerships with high-quality managers, ramping our co-investment program, and embedding data into all aspects of our program and decision-making. On slide 72, we highlight the current market environment. As Lauren mentioned earlier, there are macroeconomic headwinds which have led to a significant market pullback since the highs experienced in 2021. While private equity valuations shift more slowly than public equity, the underlying businesses face the same environment. And we expect the absolute return of private equity to decline in the coming quarters. At the same time, we see opportunity. The valuation environment for deploying capital is more attractive in times of distress, so we will seek to maintain a consistent pace of capital commitments, opportunistically look to add high-quality managers, and continue to ramp our co-investment program. Our goal is to remain consistent in our approach through all parts of the cycle. On the next slide, we give an overview of the private equity program, including asset class performance. In any discussion of the private equity asset class performance, I believe there are two important principles to consider. The first is time. So the goal of investing in private equity is to generate long-term capital appreciation. This leads us to focus on longer-term performance more than individual year performance. The second principle is measurement points. There are a number of complexities in assessing private equity, stemming from the fact that there is not an investable benchmark, as you have with public equity. As a result, we engage multiple points of measurement, including performance relative to our policy benchmark, peer benchmarks, and absolute performance. If I could point your attention to the top right-hand chart, we lay out private equity performance for the 10, 5, 3, and 1 year time periods, denoted by the blue bars in the chart. To ground you in the numbers, private equity generated a 13.5% return over the past 10 years, 15.7% return over the past 5 years, 18.3% over the past 3 years, and a 21.3% over the past year. Now, as a reminder, private equity performance is based on 3/31 valuations. Relative to last year, private equity performance has improved on an absolute basis across the 10, 5, and 3 year time periods. We've also laid out the policy benchmark denoted by the gray bars in that same chart. You can see that private equity outperformed the policy benchmark for the 1, 3, and 5 year time periods and underperformed for the 10 year time period. Last year, the private equity portfolio underperformed the policy benchmark for all time periods. On slide 75, we've laid out CalPERS private equity performance relative to peer benchmarks, both Cambridge and State Street. I would note that these returns are presented on an internal rate of return basis, which is consistent with how these peer benchmarks are reported. Here you can see CalPERS private equity program has underperformed peer benchmarks across nearly all time periods, in many cases by substantial margins. As we decomposed our performance along various dimensions, we affirmed our assessment that the underlying drivers of underperformance remain the same: a lack of consistency, diversification, and cost efficiency. We are addressing these issues one by one. We've continued to commit capital in line with a methodical pacing plan to help embed consistency into our program in a way that will contribute to outperformance over time. For diversification, We are actively broadening the private equity program's exposure to the middle market growth and venture segments. And we have established new relationships with high-quality managers in each of these segments. In regard to cost efficiency, we are scaling our co-investment program and have strong traction supporting our managers as an efficient co-investment partner. While we expect absolute returns in the private equity program to decline in the coming quarters, we believe a consistent execution of our strategy, focusing on methodical capital commitments, diversification across segments, and ramping our co-investment program, will generate durable outperformance versus our benchmark over the longer term. On slide 76, we pivot to touch on ways in which we have been working to embed sustainability more deeply into our program. And I'd like to take a minute here to go into a little more depth on the ESG Data Convergence Initiative, or EDCI for short. This initiative was born from a simple problem. Despite the significant gains in integrating ESG factors into private companies, allocators like ourselves were unable to track standardized ESG data across their private equity portfolios. So to address this problem, we convened a small group of allocators and general partners to see if we could do better. Our North Star was and remains data. We wanted to see if we could agree on ways to track a limited number of critical ESG metrics across a small group of private companies. The traction the EDCI has gotten has materially exceeded our expectations. Since formally launching the initiative about a year ago, we have expanded from a small initial group to over 215 allocators and general partners, representing $24 trillion in assets under management and tracking ESG data for over 2,000 portfolio companies. To our knowledge, this is now the largest data set of ESG metrics for private companies. And we look forward to continuing to drive this initiative forward in the months and years to come. In closing, I'll hit on slides 77 and 78, which look back on the prior fiscal year and forward to the current fiscal year. Last year was a highly productive year for the private equity program. We were able to deepen and expand our team capabilities and improve the quality of our portfolio through establishing new manager relationships and scaling with existing high-conviction managers. Further, we continue to build our co-investment program, leading to lower aggregate program fees and closer connectivity with our partners. We also completed a secondary sale, and we've seen a step function increase in our ESG engagement. For the current fiscal year, we remain focused on deepening our core competencies, focusing on manager and company underwriting, and developing differentiated knowledge in certain areas, while we will also continue to expand our co-investment program and our focus on sustainability. Thank you for the opportunity to provide this update.
Great, thank you for the update. I have a question from President Taylor.
Thanks. I think the only, I am on, okay. I think the only question I had, I appreciate your whole report, Greg, and I look forward to, as we continue to ramp up, that we will continue to increase our revenue from private equity. My question is, we are in the ESG data convergence program. We got, and you stated something, I didn't quite get how much data we've gotten so far. I know it's only been active for like 6 months or so.
Yeah, we formally launched it a year ago, but at that point we had a very small number of groups participating. So we went from, call it 15, 16 groups to over 215 groups. And we now have data for these metrics captured in a standardized way across over 2,000 underlying portfolio companies.
And that's going to help us institute our ESG program, right?
Correct.
Throughout the private equity. The only other question, or maybe statement I want to make here, is promoting broad shared employee ownership models, in private equity through our work with Ownership Works is a great thing, except that I can't even imagine most companies are going to want to play that game. So I would hope that we have other avenues rather than just this one model from, I believe it's KKR, of the Ownership Works, such as in KKR's own other funds, they aren't working with unions to unionize. So I don't think it's an only, ownership works and not working with unions. It has to be a broad, spectrum of resolutions for the S and ESG for workers and workforce issues. So I hope that's something else you're looking into as well.
Yeah, I think what you'll see from us, and one risk of highlighting an individual thing is it may inadvertently suggest that focus is only on that. But I think what you're seeing for us is we are working to engage much more broadly across these areas relative to what we've done historically. So the Data Convergence Initiative is a big part of that. Ownership Works is a part of that. Earlier we touched on some of it's more nascent, but I'm really excited to report soon some of the work we're doing on diversity. So I think you'll see us continue to try and take on significant areas like this and embed them in a much more deep way in what we're doing.
That's awesome, yeah. I think an RCP type policy using that data that you guys are getting would be a really good idea as you're underwriting the new funds and stuff, because I think as we're looking at it, you want to see DE&I, you want to see climate action in these private equity programs, and you want to see workforce issues taken care of, because those are the headline issues that come back to the board.
Yep.
So I appreciate it. Thank you.
Okay, I see no more questions or requests to speak from the board.
So I'll cover real assets. To recap the fiscal year 21-22, I'm pleased to communicate the real assets team has had an active and productive year. It marked the first team the year's implementation of the 5-year strategic plan that was approved by this committee in July of 2021. 3 key tenets of the plan included deploying capital at scale and disciplined manner to meet the total fund strategic asset allocation target, growing our infrastructure program by sourcing and partnering with market-leading managers, and expanding our business model to include commingled funds and co-investment accounts while maintaining a continued focus on separate accounts. Go to slide 82,
You can
please.
slow down just a tiny bit.
Sorry.
I'm having a hard time keeping up with you. It's exciting stuff, though.
The role of real assets, specifically providing predictable cash yield, drives the focus on core assets that offer resiliency through cycles. The real estate portfolio is concentrated in well-located assets with defensive characteristics, and the infrastructure portfolio is comprised of essential assets with predictable revenue models. Consistent with the strategic plan, the team continues to focus on deploying capital at scale while maintaining high underwriting standards to achieve them and maintain the strategic asset allocation. Move on to slide 83. Areas of concern for the real estate program include increases in interest rate, inflation, and the slowdown in consumer spending, which have led to some repricing in the markets. Early evidence of this repricing is shifts in valuation metrics. Discount and cap rates are expanding, and rent growth and leasing assumptions are moderating. Furthermore, there remains uncertainty related to long-term negative impact COVID has, especially on office and certain transportation assets. Some themes that we're observing: investors continue to be interested in private markets, which has increased competition for assets. The current dry powder for the real estate and infrastructure area is in excess of $600 billion. Investors are altering their portfolio construction and targeting essential assets such as renewables and long-term contracted assets with inflation protection. Multifamily and industrial are the favored real estate sectors due to their essential nature. Moving on to slide 85, I'll cover performance. Real assets is meeting the return expectations set out by the capital markets assumption approved by the board. It is also living up to the role by providing stable income return. Over the 1, 3, 5, and 10-year periods, the income return was approximately 3%. Although the real assets portfolio has shown strong absolute returns, it continues to underperform the real assets policy benchmark, which has been driven by the outsized 1-year performance in industrial and multifamily of 55.4 and 36.1 respectively. Core real assets outperformed the benchmark over the 3, 5, and 10-year periods, and real estate outperformed the benchmark in the 3 and 10-year periods. Though infrastructure delivered strong absolute return of over 14%, it underperformed the real assets policy benchmark. There continues to be a mismatch between the infrastructure portfolio and the real assets benchmark. This is something that we will work with Total Fund to address in the future. Moving on to slide 87. Real asset sustainable investment objectives have primarily been focused on integrating ESG risks and opportunities into the investment process. Along those lines, we continue to evaluate emerging tools to better assess physical and transition risks associated with climate change, and research opportunities associated with energy transition. The Energy Optimization Initiative provides a systematic approach for identifying attractive opportunities that reduce carbon intensity and meet our return expectations. There continues to be broad participation from our managers in benchmarking sustainable practices through GRESB. Moving on to slide 88. After the GFC, the focus of real assets was transitioned to core assets because these assets provide predictable income streams that match well with our long-term liabilities, protection against inflation and price volatility, and resiliency through business cycles. Over the past year, staff successfully deployed capital at scale. Our preference remains to invest in separate accounts where we have more control, transparency, and favorable fee structures. In real estate, assets are predominantly owned through separate accounts where we have deep strategic partnerships with sector specialists, many of which are long tenured with CalPERS in over 20 years. In our separate account, CalPERS retains key rights which provide us better alignment with our managers. These include the right to remove the manager, control leverage levels, transfer assets, and the ability to extinguish allocations. Separate accounts have enhanced our performance through economies of scale, reducing fee loads, expertise from sector specialists, and unique fee designs, which rewards managers when their performance is consistent with the role of real assets. Infrastructure, we've expanded our manager bench through strategic relationships. We invest in commingled funds with co-investment components with market-leading managers. Going forward, we will work with Total Fund to address the infrastructure benchmark mismatch, where we are currently benchmarking infrastructure performance against a real estate benchmark. A priority for the current year is to advance the strategic plan implementation, including human capital and technology resource planning. To conclude, I would like to underscore the importance of maintaining a disciplined and consistent approach to the deployment of capital. Our focus on separate account with aligned managers and core stabilized assets positions the portfolio defensively, allowing it to be resilient during periods of market uncertainty. As we look back, we have made good progress implementing the strategic plan, but there is more work to do. Thank you, and I'll now take questions.
Okay, thank you. Very encouraging, particularly the continuing impressive performance of the core real estate stuff. So I have a question from Director Willett.
Thank you.
Hang on, try it again. There,
thank you, Chair Miller. Thank you again to the staff for such a really thoughtful and excellent presentation today. I know we're nearing the end, but I just, as noted earlier, it's been said a few times, I really appreciate our leadership on ESG integration into all aspects of the work we do, and specifically here in the real estate assets. As noted in the responsible contractor policy too, and it does speak on, I guess it's slide 87 actually. It notes the GRESB, which, if I understand correctly, helps establish ESG standards in real estate. And so I'd like to request, I know we're going to talk about the RCP policy more in November, but if you could talk about how the GRESB addresses our ESG work and aligns with our RCP work.
Yeah, so the GRESB questionnaire is actually quite long, and the manager spent a significant amount of time responding to those questions. I can work with the staff to get some additional information to come back to you with that, if that's the direction from the chair.
Yeah, that sounds like a good direction from the committee for next time, and we can have a little more fulsome discussion at that point.
Thank you so much.
I'm seeing no more requests for questions from the board, so I think does that conclude 5D? Okay, again, thank you all for I can tell how much work went into this, and it reflects all the fine work that's been going on for months, and just really looking forward to, when we hear more of the fruition of these new efforts. And I know that particularly culture change is certainly a long-term project, but I think we've got such a strong culture to build from, and such a exciting new directions and new leadership. So we're looking forward to great things in the coming days. So at this point, I think we will break for lunch, and we'll reconvene. It's 1:30 now. Let's say 2:45. Does that sound good to everybody? And with no objections, we'll. Okay. So.
Do you want to have the two speakers?
Oh, they're for the end because they're F.
Okay.
Yeah. So okay.
Chair Miller, what time for reconvening?
2:45.
Can't put that up and block people's way.
What's that?
Oh yeah, people have to be able to get out.
Do you mean 2:15? That's 45 minutes.
Oh yeah, 2:15. Yeah.
2:50. I was wondering because that would be an hour and
minutes,
15.
yeah.
Okay, great. 45 minutes.
Yep. Okay, we'll be back at 2:15. So we're adjourned for now. We're breaking for now.
Recessed.
Recessed. That's the word.
I agree. It's been way up.
I ran out of tea and I can't function without it. If everybody would take their seats, we'll get started, and we'll jump back in to information agenda items with 5D, the CalPERS Trust Level Review Consultant Report and Annual Program Reviews.
Good afternoon. Tom Tote with Wilshire Advisors. Pleasure to be speaking with everybody this afternoon. And we've had, I think, a very fulsome discussion in terms of performance. So I'm going to try to focus on just a few slides around performance, which I hope will really be more additive to what staff has just covered. So in item 5D in attachment 1, if we could flip to page 22. Hopefully I got my page numbers right. Perfect. So these next two charts that I wanted to illustrate, I think, provide a graphical description that helps you get a sense for consistency. And so what we're looking at here is a rolling 3-year chart of active performance. So that is performance plus or minus the benchmark. And so what you can see from 2013 through 2016 is that broadly active return averaged about a positive 25 basis points or so. However, from 2016 to about the middle of 2021, that active return was averaged closer to a negative 25 basis points. And more recently, you can see in the far right side of that chart, that's moved back to a positive 25 basis points. And my point here, and I think it's an important one based on the discussions that we've had, is that the active returns have been inconsistent, being above for a period of time, then below, kind of averaging out to sort of close to zero. And the ambition of a more targeted active risk-taking is to improve that consistency and ideally shift those results up, such that you're seeing consistent outperformance relative to the benchmark kind of across time. To use some financial jargon, you're looking to generate alpha relative to your beta asset allocation. So on page 23, this is a similar chart, but this looks at that active risk result. So this is the rolling tracking error of the portfolio on a 3-year basis over that same period of time. And as you can see, going back to 2012, that tracking error was north of 2.5 and has steadily declined over time to a low of about 1% in mid-2019. Now, subsequently, that has climbed back to about 1.75%. That has been driven almost entirely by the active risk associated with the private assets within the portfolio, as staff alluded to earlier. The actionable tracking error, or the amount that is more readily controlled by staff through active tilts within the public portfolio, is currently quite low at about 0.1% or 10 basis points. So there is significant room to increase that active risk-taking and stay well within the board's limit of 1% actionable tracking error or actionable active risk. So those are the two slides that I wanted to cover here. I think it kind of illustrates a lot of the points that were made in the much longer conversation with staff, but let me stop there and see if there are any questions. Okay.
Not seeing any.
Fantastic. So attachment 2, I won't ask you to turn to. That is our broader performance report that is created independently of the work that staff does. I actually will move us to attachment 3, which is getting into the program reviews and the work that Wilshire does in terms of evaluating the efficacy of some of those programs. And maybe before we dive into some of those key points, I thought it'd be helpful to provide some background on these write-ups for the benefit of new members and maybe a refresher for those that have seen this before. Our annual program reviews are structured very similarly to the way that Wilshire evaluates external money managers. So focusing on facets like the broader organization, the team that is implementing the portfolio, how they gather differentiated sources of information and use that to come up with forecasts for security performance, and then taking those forecasts and creating a portfolio, so portfolio construction score, and then how do they implement that portfolio within the market, so implementation and attribution. And our scoring is tiered into deciles. So essentially you can think about that as basically 1 through 10, where the deciles, the first, second, third, and fourth deciles are above average. Fifth would be considered an average process, and then below average. And we do correspond those deciles to letter grades, which you might have seen in the appendix, where the first and second deciles are A-rated, third and fourth B-rated, and so forth. And so these are really meant to provide the board with an independent look at the investment teams, really across the portfolio. And I'll focus these initial comments on kind of that high-level organization before we delve into the various teams. And past Wilshire reviews have highlighted our concerns about staff stability. As everyone knows, a successful investment program really requires a true long-term investment horizon, and that comes from a consistent and enduring investment philosophy. So stability at the senior level of any investment organization is really how you build that enduring investment philosophy. And this year's overall organizational score has been increased, given the hiring of a new chief investment officer. And the conclusion of that search, we feel, removes a substantial distraction for the broader organization. And so Wilshire's evaluation and our score reflects that. Other changes that impacted our score are the appointment of the interim chief operating investment officer, as well as the positive impacts from allowing both the DCIO and the MID of fixed income to resume focusing on their established duties, as opposed to the interim roles, which they have, I think, ably fulfilled over the last year and a half. We do view the updated governance very positively with the establishment of those governance committees, which we talked about at length around operations and administration, total fund management, and the investment underwriting committee. The fact that these committees are made up of the senior investment professionals across multiple market segments really should provide a diversity of experience and insight, and we view that very positively from a management perspective. And lastly, on the broader organizational score, we would expect that score to continue to increase as we move through time and that stability continues to be demonstrated. So we didn't ratchet the score up dramatically from where it was to an A. We generally take a more gradual transition towards those higher rated scores as, again, time and stability continue to be exhibited. I did want to highlight a risk around resource constraints for the board and the investment committee. As you know, CalPERS continues to compete for talent in a very tight labor market. And this isn't a CalPERS specific issue. This is one that is impacting certainly many investment management organizations and, frankly, industries really across the economy. Of note, I would point out that the teams are stretched in private debt and global fixed income. This is quite impactful given the new dedicated allocation to private debt and an expanded mandate within global fixed income with the emerging market sovereign bond portfolio target. Importantly, as we think about things that can be done to improve the resources associated in the investment office. Discussions around compensation are certainly going to come up around that. And we think that any of those discussions really need to take into account the understanding of the risks that changes can introduce. These risks can be personnel related, around turnover or recruiting and retention, or portfolio related. And that's an important dynamic because it can impact how much active risk is actually incorporated across the investment programs. And I know a deeper dive is scheduled to have these discussions within the appropriate committee. And we think that is absolutely a good opportunity to delve further into those aspects. As you heard in the earlier staff discussion, active risk management is a strategic priority moving forward, and there is significant desire to explore adding additional active strategies through a focused, what we would call a risk budgeting lens. That's a term that you will hear quite a bit, I think, going forward. And in a challenging return environment, and we've talked about this over the years with low expected returns in some asset classes, active risk-taking presents the opportunity to enhance returns, but it needs to be pursued in an efficient manner. And the specific details that underlie the pursuit of those returns are really going to be critical to its success. So Wilshire, as the board consultant, will need to evaluate them on a case-by-case basis before we opine on their relative merits, and I imagine we'll be very actively involved with that discussion and certainly look forward to it moving forward. And the value of that active management comes not just in enhancing returns in a vacuum, but ideally is doing so in a manner that's uncorrelated to broad market direction in order to compound positively. So that's outperformance. I think it's important to recognize that outperformance in a down market is just as valuable as outperformance in an up market. And so that's really what we're striving for when we're talking about alpha. That's excess return that's uncorrelated to broad market directions. Those are my comments on the broader organization. Happy to answer questions before I turn it over to my colleague to cover a few of the investment programs.
Okay, seeing no questions, I would say Ali, carry on.
Good afternoon. Ali Kazemi, Wilshire. Wanted to cover two of the programs before handing it back over to Tom. First is the Trust Fund Portfolio Management Program. And the role of TFPM within the portfolio has undergone several evolutions throughout the years. However, one common theme we noted in our review this year is over the last 12 months that those core functions have been fairly similar than what we reviewed last year, so that was nice to see. We largely break out the functions into four categories. One is allocation management. You can think of that as the team that handles much of the day-to-day work of not only the PERF, but the affiliate funds. We've got the investment treasury and trading function, which was centralized several years ago, and it's meant to help reduce some of the operational risks related to the trading function. The research economics group supports PERF by driving thought leadership and assisting with support on various projects for other programs within the broader investment team. Portfolio strategy is a complement to the research group. It's really focused on the strategic asset allocation evaluation, looking at drawdown risk, and helping to provide asset class research support for the other programs. Lastly, the portfolio design team. This is a recent carve-out under TFPM, which started last year. The intention is to complement the portfolio construction process by helping to guide how the approved asset segments essentially come together. And so, utilizing our standard framework for scoring, which Tom touched on in his comments, our scoring places the TFPM team in the 4th decile. That is a slight downgrade from last year when it was 3rd decile. And the primary driver for that decrease is really related to resource issues, and Tom touched on that in his comments as well. We have noted that there are issues related to resources within that team, some open positions that are still in the process of being filled. And so our scoring is primarily driven by that. The information gathering, forecasting, and portfolio construction scores are still very strong. And our team and attribution scores remain high. So that slight decrease still keeps it in the above average territory, but is a reflection of some of those resource questions that we raised in our opening comments. Moving forward to the Global Equity Program, Samiso was up here earlier to kind of walk through the Global Equity Program as a whole, and I think his comments were well said in terms of describing its role. But just to reiterate, its mandate is to essentially deliver the global equity beta risk premium, which is that strategic exposure to global growth, which has obviously been front and center in some of the performance discussions that we've had today. You can think of the three underlying core functions of global equity broken out by portfolio implementation, portfolio structuring, and then the corporate governance component, which Simiso also touched on. In our view, this program has essentially performed as expected over the last 12 months, and Wilshire sees a high degree of consistency between our review last year and in talking with the team this year. The major improvement really coming from the hiring of the MID, which has been viewed as a very positive development for the overall team and kind of the overall culture within the team. So we're very high on that move. In addition, just from a performance standpoint, that portfolio is vastly index-oriented, with almost 97% of the assets in index-oriented strategies. Even with that tight tracking error, the portfolio has been able to add some incremental value, about 15 basis points this year on top of 31 basis points the previous year. So given that tight tracking error band, it's nice to see that some of those legacy existing active and alternative beta strategies are adding value over the last 2 years, frankly. So given all of that, in terms of our scoring, the GE program is still in the third decile. So this is the same score as last year. As Tom mentioned, third decile alludes to about a scoring of B from a letter grade standpoint, above average. This reflects a minor increase in the quality of the team score with the hiring of the new MID, as well as a minor increase in the information gathering score, as we felt that really positive communication between not only GE, but the TFPM team in terms of those research groups communicating with each other, working through the implementation of the strategic asset allocation, and so that also was a factor in increasing that segment score. So overall, the score continues to reflect a very strong team that is engaged with new leadership in place. The communication channels seem to be strong and reflective of what we think is a very collaborative culture. So with that, I'm happy to answer questions before passing back to Tom for the rest of the segments.
Thank you. Yeah, we have several questions. We'll start with Frank Ruffino.
Thank you, Mr. Chair. I had a question for Tom earlier about the co-investments. So I noted obviously in your report on attachment D that staff completed an aggregate $2 billion or approximately 21% of the aggregate commitments, no low fee co-investments, and so on. So the question is, as the team has ramped up activity in this area, are there any early indications on how these co-investments are performing?
Mr. Ruffino, I probably would defer to the private asset consultant to discuss that, or potentially Mr. Ruiz as well. I can certainly give general commentary, but specifics I think would be better left to them. Do we want to do that, or?
We can get the answer later, Mr. Chair.
Okay, thank you, Frank. Okay, and next I have President Taylor.
Yes, thank you. I had a couple of questions. I don't know if it's for you guys or for Dan and Nicole. You were talking about resourcing issues, and I guess I have as I understood it, there are positions available. Did we wait to fill them because we didn't have the CIO? Is that why we had resourcing issues? Because I'm pretty sure the board has made it very clear that if you need positions. Oh, Michael? There we go.
Hi, good afternoon. Michael Cohen with the Investment Office. I think the answer, certainly like everywhere in state government, the Investment Office and all of CalPERS is struggling sort of filling some of its positions where we used to get dozens, if not hundreds of applications. But more broadly than that, you'll recall that the executive team at CalPERS established a position pooling concept where those positions that were needed by a particular area are available basically for any of the branches to make a proposal for, and then the executive team can sort of authorize additional positions. So I think between working through filling positions, that certainly some of them were held as we were kind of waiting for Nicole to get on board, and then there's a domino effect downward.
Okay.
Between that and access to additional positions from the pool the executive team has already provided a substantial number of positions, more than a dozen, to the investment office in the areas that really saw the greatest expansion under the strategic asset allocation. So all of the private assets that you've been talking about the rest of the day. So those are just about filled up. So
we're moving on from.
Yeah, I think going forward, I don't want to understate that there is a challenge certainly in filling positions, but we do have resources from a position allocation standpoint within the organization that should not be constraining upon the investment office.
Okay, I just wanted to make sure because I thought we were pretty clear about that. Go ahead, Dan.
Yeah, I agree with everything Michael said. The only thing I would add to it is that we've had a number of positions, and Arnie spoke about it a little bit too during the program review. We've had a number of positions sort of in the market. We're making traction on a lot of them, but we're also having challenges in some of them. We found that we're going out with recruiters more frequently. It's a tight labor market. Sacramento can present a challenge. It also presents an opportunity, but it can present a challenge. We've talked about our, all of the aspects of our sort of employment program, including compensation, location, all of those things, and we're working our way through. But I agree with Michael that we've definitely had the support of the organization and of the board. It's just a tight labor market, and we're working through it.
Okay, I just want to make sure, because that can't possibly be a primary factor of poor performance, I wouldn't think, because I hadn't heard about that until just now. So, and I will say, Tom, you kind of gave us kind of an idea of what factors, and Nicole did earlier, what factors led into poor performance. And we get it, we needed to be better in private assets, and there were a couple of, a bunch of other things that factored into the performance. I just want to make sure that we're not highlighting, I think both of you said it was a primary thing, the resourcing issue, and I just disagree with that. I don't think that was the primary issue.
And President Taylor, maybe let me clarify. My point was that it's a risk, not a driver of underperformance necessarily. And so as we're looking at the efficacy of implementation moving forward with the shift in the strategic asset allocation, trying to anticipate the resources going forward. So that was really more of a prospective risk factor than it is a reason for past performance. It was very much forward-looking, not backward-looking.
My misunderstanding.
Yeah, I would just echo what Tom said. I mean, this is meant to be kind of a qualitative view of the team and the structure itself, rather than a justification tying historical performance to what we evaluated qualitatively. We do factor in performance in terms of making sure if there are any outliers that we can explain those types of things, but really this is meant to be more of a qualitative review of kind of not just staffing, but overall communication, what we see in terms of how the groups are working together. And albeit these are very, very slight decreases. When we look at the actual scoring methodology, we're talking like razor thin decreases here, but we want to be as transparent in terms of communicating what that means in terms of our rankings.
Okay, great. I appreciate that. Thank you.
Okay, next we have Controller Yee.
Thank you, Mr. Chairman. Just a couple of questions. I haven't heard anything mentioned with respect to leverage, and just wanted to kind of get your thoughts, and I'll ask this of Makita as well, with respect to some of the other asset classes. But is the amount of leverage in the portfolio appropriate? Are we able to make any assessment around that issue? And I think when we hear about private debt and real estate, I'm just curious as to whether, as the fundamentals change with respect to those areas, whether we're entering into a more, kind of risky situation as it relates to leverage.
Sure. Ms. Yee, maybe I'll touch on the leverage aspect just to answer the question right up front. Yes, I think the amount of leverage remains appropriate and not outsized relative to the portfolio construction goals that you have moving forward. I can say that we've been closely involved in discussions with staff around implementation, and it's a very judicious step into the strategic leverage target that's been approved. It is not something that is being implemented, in one fell swoop, because that would introduce an aspect of market timing we don't think is appropriate. So it's being very thoughtfully implemented. So we feel comfortable with where that currently stands. And then I believe your second question was around private debt and potentially impacts of leverage there. Certainly fundamentals, much like broader credit markets, have gotten more challenged with spreads rising. That's true in both the public and the private side. I think the benefits on the private side is, as the investor, you can be more involved in the structuring of those opportunities, and it gives you a greater opportunity to drive some of those, to put in place those value drivers to protect yourself as the lender. And as things are more challenged in the broader global market, the private debt borrowers are more open to it because, frankly, they kind of need your capital.
Yeah, exactly.
And that's a benefit for CalPERS.
Good. Good. No, I'm very happy to hear that response. And then just kind of in your opinion, have the defensive positions that CalPERS has taken to reduce drawdown risk paid off?
So the one that has is the low volatility equity, and I'll show that to you when we get to one of the later attachments, the trust universe comparison.
Okay.
The one that did not during this drawdown was the longer duration aspect of the fixed income portfolio. That has been a challenge, the long treasury being the purest example, but true in the long credit side as well. It has interest rate sensitivity. So I'll say it's a bit of a mixed result there. The risk mitigation from low volatility equity, I would say, has worked as expected strategically over the last, call it 18 to 24 months. Long duration fixed income has not.
Okay. I appreciate that. Thank you. Thank you, Mr. Chairman.
Thank you.
Director Pacheco.
Thank you, Chairman Miller. Thank you, Tom, for this information. So my question is back on I think it's agenda item 5D, attachment 3, page 7 of 23 on the scoring. But what I wanted to know was, with respect to the new governance framework that we've outlined earlier in our talk, do you feel, what is your opinion that the staffing challenge may have on the future Wilshire quantitative score? Where do you think that may land, in your opinion?
Mr. Pacheco, hard to say. I would expect that, as was alluded to earlier, the progress is being made in terms of ramping up staffing, and so we are cognizant of that. And some of the discussion that we have internally, as well as when we're having regular reviews with the program teams, is looking at their org chart and looking at reporting lines, looking at where open positions are, and understanding the history of that. So how has the size of the team shifted over time based on their mandates? And so I think as we move forward and we see some of the, I'll call it new hires come in to fill some of the, I'll call more specialized roles in the private debt area, for example, or maybe partnerships on the emerging sovereign side. That will factor in, but I don't want to forecast and say I would expect if that happens, then our scores will go to X. It's a much more qualitative discussion than that.
So it's a wait and see kind of moment then, basically, in your opinion.
Yes, but I want to be very clear that as this is essentially an ongoing process, this is not just a discussion that happens once a year and then we report this to the board. We are interacting with staff on behalf of the board as your consultant through the year, every month, multiple times, depending on which programs we're talking to. And so if we were to see an issue that would require, immediate concern, caused immediate concern, we would bring that up to you well in advance of sort of the wait and see to the next go around of these program reviews.
So if I may add just one comment, Rosedine and Wilshire, the reason why we highlighted the issue with staffing within the private debt program is twofold. One, obviously, it's a new allocation, which requires a lot of work up front to deploy the capital that's been allocated. So that has been the focus of the staff, to deploy that capital as judiciously as possible, as well as quickly as possible. The second part here is that as the capital gets deployed, now the staff is not only charged with deploying additional capital to get to the target, but to manage the existing invested portfolio. So in terms of portfolio management, as well as finding new investments, will be an additional task for them to manage the portfolio judiciously. So we're highlighting that as the program ramps up, there will be additional needs for staff to be further enhanced.
Okay, that brings back to the same question again when you mentioned earlier that both private equity and private debt are, the staffing is very thin. I mean, there's they're really tight with respect to what they're doing. So, what is, I guess the question is, how are we, what do we need to do from a committee perspective to kind of, get it going, get the hiring going and so forth? I mean, what are your thoughts on that?
So if I may, very quickly, I think President Taylor's comments go a long way towards addressing that effectively, not to put words in your mouth, but you have the resources you need, tell us what you need, and we will support you as a committee. So I think it's been addressed.
Okay, very good then. Thank you.
Yeah, I would just add to that, in terms of kind of the subcomponents, when we score that area, we look at commitment to improvement, we look at the quality of the existing team, and then we look at stability. And when we look at the commitment to improvement, we've rated that as an A. When we look at the quality of the existing team, we've rated that as an A, where the scoring was brought down is just the stability component of that. So you've got the commitment, you've got the quality of the folks already here. It's just about seeing some stability going forward in terms of the retention and recruiting, and that would naturally lead, I think, to higher scores in the future.
Thank you very much.
Okay, thank you. Next we have Director Middleton.
All right. Tom, Ollie, excuse me, thank you. A couple of areas. Could you talk about your comfort level with ESG strategies that are being employed in the investment office? Most specifically, do you have any elevated concerns when it comes to private equity and private debt in embedding ESG into the programs?
Ms. Middleton, let me think about the best way to answer this. So I wouldn't say that we have elevated concerns about utilizing ESG as part of the investment process within private equity, private debt, or other areas either. I think ultimately these are risk factors that a prudent investment process should take into account in terms of deciding whether the risk-adjusted returns that are likely to be delivered by those strategies are prudent. So no, I don't think there is elevated concern there, but you'll almost never hear me say there is no concern, because I tend to worry too much is what it boils down to.
So the argument that, phrased differently, that private equity, private debt creates greater ESG risk is not one you would accept. Is that accurate?
I think it's, Ms. Middleton, I think it will ultimately be opportunity specific. I could come up with scenarios where it does, but then I could come up with counter scenarios where it's addressed and mitigated through things like the RCP, which was mentioned earlier. So I wouldn't want to draw a blanket statement.
All right, thank you. Another area, earlier this morning, staff outlined some changes with the PPO process. Are you comfortable with the changes as recommended?
We are comfortable, and I wanted to specifically address the lack of the PPOs in the opportunistic strategies. It is something that we pointed out in our opinion letter to the board and discussed with staff, and it comes down to, as was stated, balancing nimbleness of investment decision making with prudent governance. And I think because of the governance structure, particularly the underwriting committee, that provides an appropriate level of governance so that the board can feel comfortable that there are multiple eyes on all of those opportunities. And to the extent a PPO is used, it's very much a belt and suspenders approach. It's not a replacement for the diligence that's being undertaken by staff. And I think that's an important thing to remember.
Fair enough. Thank you.
Okay, I'm not seeing any more requests to speak, so
I will, if I may, Mr. Chair, just quickly touch on the other two programs, the one being Global Fixed Income. As the staff stated earlier, that is a portfolio that is strategically designed to provide diversification, particularly against equity risk, as well as a high level of liquidity and income. It is substantially actively managed with more than 95% of the portfolio managed internally and the rest outsourced to a few key external managers. From an active return standpoint, the GFI program, it almost matched the benchmark. It was effectively in line over the last 1 year time period. But over longer term time periods, the global fixed income portfolio has been one of the most consistent sources of value add, again, relative to the benchmark in the portfolio. Our qualitative assessment of that program places it in the third decile, which is the same as last year. It does reflect the impact of that increase in the organizational score, but a reduction in information gathering resources as they have lost a few team members, and we want to reflect that. It does the consistent score within portfolio construction and implementation, which were very highly rated, remains. And overall, that third decile score, we think, does reflect a strong team in place and long-term success at managing that portfolio in a very challenging environment. By some estimates, the most challenging fixed income environment in 100+ years, if you look at some of the longer term academic studies. The last program is the Opportunistic Strategies program. As we talked about earlier, it's meant to invest in strategies that don't fit neatly into one specific asset class, but do have relative value characteristics to enhance performance. And during the past few years, the program has been focused on building out private debt and has really incubated the initial commitments that are now kind of those first, the first ones within the new private debt allocation. We ranked the OS program in the 3rd decile as well. We feel it's led by very talented staff who have a very strong understanding of the opportunity set and the value drivers, particularly the demonstrated ability within private debt with some very strong performance, which Arnie walked through earlier. And then we have talked about, as that area grows and the requirements for portfolio construction, as well as committing new capital, become more acute, we do think it could stand to utilize to bring in some additional resources. There is more detailed information on the scoring in the appendix of that opinion letter, but I will stop there and answer any questions before we move on to the universe comparison report.
Nope, I'm not seeing any more requests for questions, so we'll continue on.
Great. So attachment 4 is the Trust Universe Comparison Service report. So if we could pull that up. And I wanted to, again, I think make some comments which hopefully will be additive to a lot of the information that we've talked about already. So the CalPERS portfolio ranked at the 59th percentile over the last fiscal year and at the 80th percentile over the past 10 years. Staff earlier provided insight into how the portfolio has evolved over that time, and the information that we collect independently as part of this comparison have confirmed many of those takeaways. The portfolio has been structured with lower exposure to growth-oriented investments, felt most acutely in a lower level of exposure to private equity. Ms. Yee and Mr. Rufino earlier asked about risk versus peers. If we look at slides 4 and 5 of the Tux presentation, you will see that the PERF portfolio has lower risk in comparison as it plots to the left of the median risk line, so the line that's going up and down. So it's to the left relative to peers. Over the last 3 years, the PERF's volatility was 11.24% versus a median risk level of over 12%. So it's certainly fair to say that PERF portfolio exhibits a lower level of measured volatility, and that's been a drag on returns relative to peers over the last 5 years as riskier assets have outperformed. On slide 6, that is a comparison of the asset allocation across for the PERF in comparison to larger public pension systems. The two differences that jump out are, in fact, that higher than average allocation to global fixed income. That is inclusive of both investment grade and non-investment grade exposures, and a lower than average allocation to private equity. And we've talked at length about how much that has impacted returns relative to peers. Turning to some of the underlying composites, I did want to highlight just a few items to provide some, I'll say, quantitative support to some of the comments that have been shared today. If we look at page 7 and compare the global equity portfolio, it does include that dedicated allocation to factor exposures, and that equity factor exposure did protect on the downside to Ms. Yee's earlier question over the last fiscal year. And in fact, the global equity portfolio relative to peer global equity portfolios ranked at the top quartile, at the 25th percentile. So worked over the last fiscal year, but that lack of growth exposure, as Nicole's earlier slide showed, was a drag, particularly during the post-pandemic rally, where growth-oriented stocks, large cap tech in particular, dramatically outperformed relative to the broader market. On page 9, we can look at private equity. Over the last 10 years, the portfolio ranks at the 41st percentile, so it is above median, with a return of 13%. And that, again, quantitative support to earlier comments, that's a premium of almost 3% relative to public equity returns over that 10-year time horizon. If we look at global fixed income on page 11, there's no question that the portfolio has struggled versus peers over the last 2 years, given its longer duration positioning and higher sensitivity to interest rates. It is worth noting, though, that if you look at the 10-year results, even inclusive of those last 2 years, the fixed income portfolio ranks at the 37th percentile versus peer fixed income portfolios, so almost at the top third of that universe over that full 10-year horizon. And then one final comment on those underlying mandates. If you turn to real estate, the real estate portfolio has outperformed peers over the past 10 years, also coincidentally at the 41st percentile over that 10-year time frame. So hopefully that provides a little bit more context and peer comparison information from Tux, and I'd be happy to answer any questions that the committee has.
I'm seeing no questions, so I think everybody's good.
Fantastic. Well, I think I will turn it over to Makita, who will handle, I believe, the last 3 attachments in that agenda item.
Great. Thank you very much. I appreciate your input.
Absolutely. My pleasure.
And welcome to Makita.
Good afternoon. Yes, there's more. Steve McCourt, Makita Investment Group. To my right, Steve Hart. To his right, Christy Fields. To go through our reports verbally fairly efficiently, I'll be going through them, but obviously we're happy to answer questions either along the way or at the end. The theme of this meeting seems to have been humility about the last 10 years. As I thought about these asset classes, their performance historically has actually been quite good. I think where the humility might be needed is on a forward-looking basis. And so I wanted to talk a little bit at the beginning about the market environment and pricing of private markets. As staff indicated in going through the performance review, your private market asset classes are valued as of March 31st, so there's a lag in the valuations. To say the least, March 31st was a very different point in time than today is. And the most significant change has been the increase in interest rates in the economy over that time period. The public markets generally reflect price movements in real time. In fact, sometimes they overreact to changes in fundamentals in the economy. The private markets take a long time to do that. So while interest rates have moved up considerably, the 10-year Treasury bond today is yielding 3.5%, give or take a few basis points. Huge increase from the beginning of the year. Most private market asset classes haven't yet begun to reflect how rising interest rates or higher interest rates will impact valuations. And that's for a variety of factors, partly having to do with the lagged nature of valuations, partly having to do with those valuations being based on transactions in the marketplace, and it takes a while for transactions to occur under new economic realities. All of this is to say that the roughly 30 to 40 percentage point outperformance of private markets over public markets in your fiscal year will erode at some point in the next year. Not fully, hopefully, but some portion of that will erode as private market valuations begin to reflect the economic reality of rising interest rates. So with that rosy note, I will go into the performance first of private equity. For your fiscal year ending June 30th, the private equity portfolio was up 21.3%, outperforming your policy benchmark by 13 percentage points. I wanted to highlight here the fairly significant improvement in returns versus your benchmark over the last 5 years. 5 years ago, over the then trailing 5-year period, your private equity program was underperforming its benchmark by over 2% per year. In this 5-year most recent period, you're outperforming by 2% per year. So a really nice turnaround in relative performance of private equity. In terms of implementation, to echo some of the comments that Greg highlighted and has continually communicated to the committee in the strategic plan updates, the private equity team has done a really strong job over the last several years in more consistently deploying capital each year, increasing the cost efficiency of the program through more co-investments that are being executed, and adding to diversification of the portfolio by investing more in sectors of the private equity markets that were underexposed previously. For the most recent year, your private equity staff made 69 commitments totaling $17 billion. 5 or 6 years ago, that number was more like $4 or $5 million. So a significant increase in activity in recent years. Your private equity program was in compliance with all of its policy limitations. Moving on to real estate. Similar commentary on the real estate market. It has yet to reflect significant adjustments in valuations as a result of interest rate movements in the economy. We await for those. The cap rate of the institutional real estate market on March 31st, when this report was done, was 3.7%. Today, the 10-year Treasury bond is 3.7%. The difference between the cap rate and the 10-year Treasury bond is typically 2 to 2.5 percentage points. So one would think that there's an adjustment coming down the road eventually. As has been remarked, your real estate staff has continued to focus the bulk of its activity around core, high-quality, income-paying properties. That strategy has continued to pay dividends in the form of strong performance for you. As we look at your core portfolio, the trailing 3, 5, and 10 years, the core portfolio is outperforming your benchmark by sizable margins over each of those periods. Your real estate program, like private equity, is currently invested within all the policy parameters. And then finally, on infrastructure, the performance of infrastructure for the year was positive 14.7%. Fairly modest compared to private equity and real estate, but certainly a strong return number on an absolute perspective. Sarah noted during her report about the benchmark mismatch between infrastructure and real estate. You'll note in our semi-annual reviews, we also show the Consumer Price Index, which was the previous benchmark for real estate. And the program continues to outperform that benchmark meaningfully over time. The one item I want to note quickly relates to the policy request to allow for a somewhat higher allocation to international infrastructure assets. As we've noted before, infrastructure has been and continues to be an asset class that is transact at higher volume outside the U.S. And as a consequence, as CalPERS views the asset class and those assets as attractive for its long-term return objectives. The amount of assets outside the U.S. will have to increase in scale with the overall program. So that's the general rationale for that policy request. I will close my comments there, and happy to answer any questions that anyone has on the 3 asset classes.
Okay, thank you for that. I'm not seeing any questions or requests to speak to that, so I thank you. Very much appreciated. So I think that if no one has anything else, that will bring us to the summary of committee direction.
All right, I noted 2 bits of committee direction. First of all, as we mentioned, we have planned to take the responsible contractor program update to an information item, not information consent. But we also took direction to add sort of the GRESB lens to that and sort of how they align. And then the second one was also from Director Willett and had to do with data on how many deals we've missed as a result of the current delegation levels and what we would expect that to change to with the new with the proposed potential delegation levels. Those are the two bits of committee direction I took.
That's all I remember. Anybody else? No? I think we got it. Okay, so we'll move now to 5F, public comment. I have several requests for public comment, and so we can come on down. We'll start with Tim Behrens, followed by Sandy Emerson and Lynn Nittler. So Mr. Behrens, welcome, and come on down. When you arrive and the microphone's on, state your name for the record, and your time will appear up here, and you know the drill.
Thank you, President Miller. I just promoted you. Chairman Miller and board members and committee members. Tim Behrens from the California State Retirees. So I wanted to first start off by congratulating Nicole and filling a position that we have not been patiently waiting to be filled. We appreciate you, and I have gone from being an angry stakeholder when I came here this morning to be an optimistic stakeholder. I really like the interaction I've seen for the last few hours between the board and the staff. So a couple of things. I'm glad that the board's going to increase more oversight. I think the board has always had the oversight, but I'm hearing now you're going to use it. So I'm glad to hear that. I'd like to see CalPERS looking closer at, I can't read my own writing, administrative tasks. I share the board members' concerns regarding global investments. I agree wholeheartedly with Board Member Middleton. I'm worried about China and their relationship with Taiwan. Amongst everything else we heard today, it sounds like at least 6 or 8 other countries are in a recession, and we have investments all over. So I'd like to continue to hear more information about that. Finally, I remember the 2008 collapse that CalPERS had, as did the whole United States. And I also remember how quickly that the CalPERS investment team was able to recoil and get back to where they were within a year. So I'm going to continue to be optimistic. I've told a couple of the management staff team that you have my backing. I think you can do it again. So let's try to get it done. I've heard more about private equity today than I've heard in the last 2 years. Interesting. I think the only comment I would make in a reminder, because I think you're going to discuss in your November meeting, that the president has a pilot program going on to privatize Medicare. And we have given the board that information. The California State Retirees has come out publicly against that plan. We have President Biden's phone number, and we're calling him, and we're calling our local congressman, urging them not to support that.
So it would be easy for CalPERS to fall into a trap because public or private equity has been offered 30 to 40% profits if they will invest in this program. And if they invest in this program, then I'm not sure I'm going to get 30 or 40% of what I'm getting today as good service in my Medicare. Thank you very much. Have a good day.
Great. Thank you very much for your comments. Is Sandy Emerson still in the house? Nope. Looks like she's left. And Lynn Nittler. Okay, I guess they've decided they didn't want to stick around to make comments today, but I'm sure we'll hear from them again at some point in the future, and they will be welcome. So I think, hearing no objections, we will now close out our open session and adjourn into and recess into closed session, and I think that's it. And we will return to close out an open session at the conclusion of closed session, correct? Yeah. Okay, so we are now moving into closed session for items 1 to 7 from the closed session agenda, and the open session investment committee meeting will reconvene following that closed session. So, thank you. We'll clear the room.
Hit the gavel.
Oh, gavel.
Gavel it. There we go.
Thought we were.
I gotta make everyone feel appreciated.
We only had 4 to sign for change.
Let me check.